hospitals out of crisis, and it's a very tight balance. And again, the problem really is that we don't have a way to reduce the harm from this virus without home testing. And I've been seeing a lot of discussion about home testing, and hopefully that will be something that really allows us to move forward in this pandemic prior to the vaccine.
Do you think the change of tone from the incoming administration will have had any effect?
I do think the change in tone is going to have a dramatic effect. We know from the very beginning of this pandemic that the highest levels of our government evaded, misinformed, and lied and took the wrong actions when it came to COVID-19. So it can only get better with a change in transition, with the change in team. And also, if you look at what the transition team has articulated, it's many of the same principles that all of us in the field have been talking about since January of 2020. So finally, we may have a pandemic response that will be on track to actually get some level of control of this virus.
Doctor, I've heard the phrase over the last few days, light at the end of the tunnel. And there seems to be a sense that we're beginning to understand how long the tunnel is. What is your sense of how long the tunnel is?
The tunnel is several months long. If you think about the general population of the United States or some of the developed countries, we're looking mid-2021 for them to have access to the vaccine. Healthcare workers maybe can start to get the vaccine next month, but it's only going to be in small numbers. So we're still going to have to think about trying to control the spread using our ordinary means of social distancing, of people washing their hands, of wearing face coverings, and avoiding congregate settings where people are too crowded together. So this is still going to go on well into 2021. There are lights at the end of the tunnel. It's really important to remember that. But again, as we said, there is a long tunnel that we still have to traverse, and a lot of people are going to die during that time, and a lot of hospitals are going to worry about capacity during that time.
In terms of the new administration, back to that, what is your sense of their ability to handle what is going to be a huge undertaking in terms of getting the vaccine rolled out, particularly the mRNA version of the vaccine, considering the temperature restrictions that are required to keep that stable?
No matter who's in charge, it's going to be a Herculean project. This is going to be one of the biggest public health endeavors we've ever done in this country and in the world. So it is going to be something that requires a lot of coordination, a lot of challenge. So it's very good that the Trump administration is allowing the transition team to meet with those individuals finally to allow this handoff to be seamless. But I do think because of Operation Warp Speed, and I would say that this deserves credit, this is one of the bright spots in a really bleak pandemic response. There is a lot of work that's been done, a lot of logistics with the U.S. military, with UPS, with McKesson, which is a company that delivers products to hospitals. So I am confident that this can be done. It's going to be very challenging with the Pfizer candidate. As you said, it requires an extreme cold chain, -70, -80 centigrade. That's going to take extra steps. And UPS, for example, is making freezer farms in places like Kentucky so that they can distribute from there. The other vaccines are less logistically tricky, but it's likely the Pfizer vaccine that's going to be the first that starts being put into the arms of Americans. There's going to be hiccups. It's not going to go off without a flaw. And it's really questionable how well states themselves can deliver these vaccines. Do they have the funding to be able to set up distribution channels? All of that's going to be really important. It's not going to be an easy thing, and we should expect that there's going to be holdups and issues with supply chain. But I do think that this looks to be a robust process, and hopefully it goes off without a hitch as fast as possible.
As I say, thank you for joining us today on Thanksgiving. Dr. Adolja, we really appreciate it. Dr. Amish Adolja of Johns Hopkins University. We should also note that he also works with the Bloomberg School of Public Health, JHU, which Bloomberg LP's founder, Michael R. Bloomberg, of course, supports. Coming up, we're going to talk shopping. Amazon backlash. Well, that's a phenomenon here in Europe. Retailers are getting ready for Black Friday, but the e-commerce giant is in Europe's bad books. We're going to find out why next. This is Bloomberg. Live from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So retailers all over the world are getting ready for Black Friday. But Amazon has ended up in Europe's bad books. In France, the e-commerce giant has agreed to postpone the event until shops reopen in December. In Germany, the Verdi Union has called a strike in Amazon warehouses on the biggest shopping day of the year. Joining us now for the Black Friday backlash, Bloomberg's Maria Tadeo. Maria, walk us through why this is happening.
Well, Guy, there's a number of reasons, and the one is, the first one I would say is very obvious. It has to do with coronavirus, and it has to do with the lockdowns. If you have a clothing store, if you are a bookshop, clearly you've not been able to do your normal business hours, you're not making the money that you hope you would have made by now, and your revenue has really plunged. You're still having to expense, however, perhaps the rent of your store and the office space that you take. On the flip side, when you look at the business for Amazon, it has really just rocketed under coronavirus. We're not able to go out on the street, so clearly we turn to online shopping, and that's being reflected in the market cap of the company, but also the personal wealth of Jeff Bezos. And that is something that is really hitting a nerve for the small, medium companies in Europe, but also for governments. They have to react to this, and they can tell that a small company doesn't have the same amount of distribution. They don't have the same means that a big company, big US company would have, and they have to attend to that. That's being reflected in some of the measures that the French government has put forward, really forcing Amazon to delay the Black Friday so that there would be fair competition for both and everyone. And then lastly, Guy, there's a huge debate here happening on the tech and the taxation. This is something we've talked about for a year. The Europeans do feel that the Americans should be paying much more and that they should play under the European playbook. So it's a lot of different issues coming into phase, but of course the pandemic really hitting a nerve in a number of countries in Europe.
Is this becoming something of a populist theme as well? You highlighted in a note earlier on the fact that Matteo Salvini was talking about this in Italy. We've also got Barcelona coming up and talking about this as well. Is this something that opposition parties, populist parties, are starting to talk about and using as a point of attack?
Yeah, they do, because it taps into the anger that we are seeing and that we are going to see. Because, Guy, I mean, this is not a secret. By the spring of 2021, we are going to see companies go down. A lot of the help from the governments and the moratoriums that we've seen on payments are going to disappear. We're also going to see unemployment level very highly or very likely go up. So clearly here you have a group of people that are unhappy, that feel they're not being treated equally, that American companies, big American tech does get some advantages that they do not get, and that of course are going to vote, whether this is a national or a regional election. It's a market, I would say, or it's a group of people that clearly for opposition parties is something that they want to tap into. And for the government, it's very difficult to handle too, because they're trying to appease everyone, but of course they'll have to decide whether you're a zombie company or not, and some will have to go down.
Maria, thanks for the update. Maria will be rejoining us a little bit later on. We're going to talk about the ski season as well. As with everything in 2020, Black Friday is going to be different this year. COVID-19 changing the shopping experience, and America's biggest apparel retailers and department stores are certainly rushing to adapt. Bloomberg's Ritika Gupta has the details.
Black Friday, the unofficial start of the holiday shopping season, is upon us. While retailers would normally showcase doorbuster deals, fully stocked shelves, and a frenzy of shoppers, COVID-19 has drastically changed the shopping landscape this season. Stores are rushing to adjust, offering seasonal deals earlier this year to avoid a holiday crunch. Stores are bulking up direct shipping and in-store and curbside pickup, with Adobe Analytics predicting a 40% rise in pickup shopping methods. Traditional brick-and-mortar businesses are also focusing on shifting to e-commerce. Online sales are expected to surge 33% to $189 billion, according to Adobe Analytics. That will not only pressure retailers to adapt, but will stretch fulfillment networks across the US. Getting that change is crucial for struggling stores to survive. Industry analysts warn that shifts towards e-commerce and contactless shopping methods could be permanent. So if shoppers don't have a good experience this season, retailers could risk losing them for good.
Ritika Gupta previewing Black Friday tomorrow. For more on how this translates across the Atlantic, let's bring in Charles Allen, Bloomberg Intelligence Senior Retail Analyst, and Bloomberg's Emma Chandra. Emma, let me start with you first of all. How big a deal in reality is Black Friday over here in Europe? It came about 10 years ago, I remember. Has it embedded itself in our cultural identity?
You're absolutely right. It is an American import. It started really because we saw Amazon go after these big Black Friday deals in the US, also the likes of Walmart, but Amazon really the sort of transatlantic company that we all came to know. And that really put a lot of pressure then on companies in the UK and in the rest of Europe to follow suit and offer deals at this time of year. It has been something that we've seen a number of companies really push and adopt as a way to get shoppers into store pre-pandemic and in the past few years. But there is some evidence to say that it is starting to wane in terms of its popularity. Some information from PricewaterhouseCoopers coming out saying that UK spenders less likely to spend this year on Black Friday, that only about 40% are looking for particular deals this time around. That can also have a lot to do with, of course, lockdown fatigue, the fact that a number of stores are closed, or most stores are closed in this partial lockdown. And so we're starting to see perhaps a waning of interest in Black Friday in Europe. Whether or not we will see the end of it, whether 2020 will see the end of Black Friday in Europe, remains to be seen. But it isn't as big as it is in the US, certainly.
Charles, let me bring you into the conversation. When I was growing up, you would wait until we saw the Boxing Day sales and then the New Year's sales, i.e. there was a run-up to Christmas that allowed retailers to make money. Black Friday has undermined that. How damaging is it for European retailers?
Well, I think, Guy, that you have to recognize that the retailers plan for Black Friday. I mean, yes, there are a lot of promotions around and things like that, but these are planned promotions, just as many of the Boxing Day ones are. So people are planning to make a profit on Black Friday. And I mean, the bigger problem is maybe arguably about how you've created this peak, you know, at the end of November, which drags a huge amount of business from early December to that peak, and then you get the build up to Christmas, and then, as you say, the after Christmas and New Year sales across everywhere. But I don't think you should necessarily see Black Friday as it was maybe, you know, in 2013 or 2014 as just, you know, discounts instead of full price sales.
Is it starting to fade?
Well, again, I mean, it's difficult to know. I mean, as we've all said, this is a very unusual year. And I mean, I think one thing you've got to recognize is that this year, you know, during lockdown, we saw what you might say is sort of traditional Black Friday items like laptop computers, you know, home appliances, televisions, some games consoles and things like that, all sold really well over the summer. So, you know, I'm not surprised that if you bought a laptop in June, you're not going to want to buy another one in November. So I think it'll have to be more than 1 year before we see that. But I mean, it is part of the planned promotional calendar. I mean, there will be retailers, you know, AO World or Dixon Scarphone, who will be sitting down, you know, next week and planning what the promotions for next year's Black Friday will be.
It's nice to look at pictures of people out shopping, not wearing masks. Normality feels like a distant past. Emma, just in terms of, you've covered retail on both sides of the Atlantic, compare and contrast the experience.
Well, it's difficult to compare and contrast it with looking at 2020, but certainly in years gone past, you know, I used to spend Black Friday standing outside Macy's on Herald Square, the center of New York, and we'd be looking at thousands of shoppers going through the doors, long queues through the morning, even as we've seen this big shift to online shopping. And of course, that is perhaps what we will see on both sides of the Atlantic being a beneficiary this year with Black Friday, is more and more people buying online. Ritika in her package talked about a curbside pickup, but we're also looking, and especially in the US, for seeing online shopping really hit a record in terms of the amount of items and the value of those items being bought. Not just on Black Friday, I should point out as well, Guy, we're looking at, certainly in the US, it is a whole holiday shopping weekend. It really gets going after people have had their Thanksgiving dinner today, then into Black Friday tomorrow, over the weekend, and of course, don't forget, Monday is Cyber Monday, and that is when we're actually expected to see the highest number of transactions.
We'll leave it there. Emma Chandra, Charles Allen of Bloomberg Intelligence, thank you very much indeed. What have we got coming up for you? the Bitcoin roller coaster. Wow, what a 24 hours we have seen. We're going to look at the strength of the crypto boom and the latest bust. It's coming up next. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So Bitcoin fell as much as 10% today. It's on track for its worst day since May. The rout began just hours after Bitcoin rose within $7 of its record high. Joining us to discuss both the boom and the bust, Danny Berger. Danny, in terms of the impact that this turnaround is going to have, how are investors likely to take it? Will it just be a blip, or do you think this is something more serious?
Guy, even though some of the weakness may have been driven around concerns of U.S. regulation, I think it's really, really difficult for investors to write Bitcoin off at this point. I love what Eddie Vanderwalt from MLive says, that Bitcoin is the comeback kid of the market. We continue to see that any weakness, even extreme bear markets, can be met again with rallies. You have more people participating in Bitcoin now. It's not just retail. Wall Street is interested as well. And Guy, listen, I'm not the biggest fan of technical analysis. I'll put it out there, but perhaps it does make sense to look at it for Bitcoin, just because it does seem to be driven more by hopes and dreams than it does any fundamentals. And Tom Fitzpatrick from Citi points out that Bitcoin throughout its entire history has these intense rallies, followed by bear markets, followed by another intense rally. So if that boom bust cycle is going to continue, that history is going to continue to play out, then if today's just a blip, we can certainly see more gains in Bitcoin. And if today is the start of a bear market, that doesn't mean it can't come back later.
So you bring up Eddie. Eddie has recently changed his view of what is happening in gold. So let's talk about the relationship between gold and Bitcoin. Gold's been falling out of bed over the last few days. Is there a connection with what is happening here? People often compare them, but is that comparison valid?
Yeah, well, if anything, I think Eddie is a fantastic barometer for what's going on in the markets and sentiment. But look, there have been people who have started to question gold as a store of value, perhaps switching over to Bitcoin. We've seen it in the ETF market. The ETF market has started to capitulate when it comes to gold. But I think Bitcoin is still too volatile to really be seen as a store of value at the moment. If that volatility comes down, then it does become a serious contender to gold. But at the moment, we also need to see more products come to the market that are more regulated. For example, the ETP, the ETN, that exchange-traded market, it has a lot in Europe. VanEck just launched one today, but they're not allowed in the U.S. The UK just put new regulations that make it very difficult to launch anything. So I think volatility coming down and more of those products really are key to see Bitcoin start to challenge gold.
Just in a few seconds, can you just walk me through what that regulatory concern was in the States?
So part of it has to do with protecting retail investors. We've seen some concern about leverage. And in the UK, same story, concern about protecting retail investors. They think Bitcoin is just too volatile and too much money can be lost.
Danny, great update. Thank you very much indeed. Danny Berger on Bitcoin. Danny will be back shortly, continuing the discussion of what is happening in these markets. We'll focus on retail. What else have we got coming up for you? Chris Watling, Longview Economics CEO and Chief Market Strategist, is going to be joining us. We'll get his take on the recent volatility we've seen, particularly around value stocks. What is his take there? Also, we'll get his take on the pound. Chris is going to be joining us shortly. This is the state of play in markets. Light volume. It is Thanksgiving. Happy Thanksgiving. This is Bloomberg.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
PM in London, 10 a.m. in New York. From London, I'm Guy Johnson. US equity markets and bond markets are, of course, closed for Thanksgiving in the United States. Happy Thanksgiving if you're joining us from there. This is what markets look like right now. European equities going nowhere in a hurry, but below the surface, the rotation, the reverse rotation, the rotation of the rotation continues. So technology is leading, up by around 1%. The cyclical sectors are underperforming. Cars are down by 1.4. Banks, energy, insurance, the mining sector coming under a little bit of pressure. US futures are telling us that we're going nowhere as well. Not much action there. Euro dollar trading with a 119 handle. That's starting to alarm the ECB a little bit. Accounts out a little earlier. And Bitcoin now trading with a 16 handle. 16,786, down by a whopping 11%. The virus, though, remains front and center. Europe continues to grapple with the pandemic. Germany extending its partial shutdown to at least now December the 20th, as it sees a record increase in new cases. Joining us now with what's happening in Germany and more broadly, Emma Chandra.
Thanks very much, Guy. 32,687 new cases in Germany in the past 24 hours. That's a record increase. We've seen new cases in Germany triple since the start of October, and the total number of cases approaching 1 million in Germany. And what this means is that the partial lockdown that we had seen in Germany is going to be extended till at least December the 20th. We're not seeing a tail off in new cases in Germany, as had been hoped with the introduction or the reintroduction of partial restrictions. It is a more nuanced story when you look at other European nations. We've got a Bloomberg terminal chart which can show you how we saw in the major European nations cases surge through the end of October into November, but they are starting to tail off. Not in Germany again, but they are starting to tail off if you look at France, the UK, Spain and Italy. And that's what we're seeing now from those nations, is this discussion about what they're going to do about the restrictions that were reintroduced. We're starting to see that some of those are going to be eased, Guy.
Yep, the UK is going to be in tears again. Talk us through where restrictions are being eased.
That's absolutely right. So first of all, let's talk about France. We heard from President Emmanuel Macron earlier this week. It had one of the strictest reintroduction of restrictions. They will be easing from this week, from Saturday. In the UK, we're going to see England's lockdown. You have to remember it's a more nuanced issue in the UK because of the different nations and regions. But England's lockdown is due to end now on Wednesday. And what we'll see is that reintroduction of the tier system with different regions, different cities put into different tiers. And what's interesting there is that London has avoided the toughest restrictions. It's being put into tier 2. That means the likes of pubs, restaurants, hairdressers, as long as they're COVID secure, they will be able to reopen from Wednesday, Guy.
Emma, thank you very much indeed. Emma Chandra with the latest here in Europe. Joining us now, Chris Watling, Longview Economics CEO and Chief Market Strategist. Chris, over in the United States, they're celebrating Thanksgiving. That means gathering, travel, etc., likely to drive a significant uptick in the virus case counts. But the markets are very much focused beyond this. They're focused on the vaccine story and life beyond COVID. Has that move now gone too far, do you think?
It's been very dramatic, of course, and you've seen that over the course of November. Some of the numbers are quite extraordinary. I was looking at the energy sector yesterday, up just short of 40% in the month of November so far, with a day or so left. So quite extraordinary, some of the sector moves and some of the rotation. But actually, what normally happens at major turning points in markets, when you get a major shift in leadership, you tend to get very dramatic moves because the shorts get squeezed very aggressively. No one's in those sectors because they've performed so poorly for so long. And you get a scramble to sort of start moving into them and a scramble to get out of the shorts. So, I think that's behind why the moves are so dramatic. But having said that, there's clearly quite a lot of speculation in this market in the very near term. And you can see that in terms of the sort of level of call option buying and some of the moves we've seen in some of these stocks, as I say. So, I think if I look at some of our indicators that measure fear and greed, the markets become very greedy on a sort of short-term, multi-week basis. So I think this is the start of a very major medium-term, long-term move, but I suspect it needs a pretty serious pause of breath or even a bit of give back to unwind some of that excessive optimism and greediness that's just sort of creeped in.
So potentially better entry points still to come?
Well, maybe better entry points than what we have today, but certainly not better entry points than we had at the beginning of November. That's right, yes.
In terms of how you manage this process. There is going to be at the moment, everybody's kind of all in on one trade, and that's the areas that have been most beaten up. So we're coming back to energy, the travel sector's getting a lot of bid. And yet I look at what is happening here and I think about the trends that have changed as a result of COVID, and I worry about the sustainability of some of those moves. Is there not a case now for becoming a little bit more nuanced in the approach you take to some of these recovery stocks? I worry, for instance, that the travel sector in particular is still in a position where it's likely to have to raise significant amounts of cash, and that is likely to be dilutive.
Well, there may well be an argument for making sure you pick the winners in each sector, the stronger hands that survive as the weaker hands are pushed out, and perhaps as some of these beaten up sectors get cleaned up a bit more over the next 12 months. And of course, then the guys that win in the sector pick up the business from the guys that go bankrupt and get stronger themselves if they're sticking around, the so-called winners. So there may be something in that. And of course, at major turning points, everything goes up, and the stuff that's the highest risk, highest volatility, the most uninteresting stuff in a way from a fundamental point of view tends to go up the most. So there's a bit of that initially, but I mean the reality is no one. I mean it is been the trade of the month, but it's not, and it's becoming the investment theme. But these things don't happen in a month. These things take multi-quarters, multi-years. I mean, no one likes the banks. Everyone I talk to, they're not interested in owning banks. They haven't been interested in owning banks for the last few months, and they're still not really convinced, particularly if you think about European banks. But if we've genuinely changed the nature of GDP growth, added a bit more inflation in, we expect some rising bond yields from here, banks is actually a very interesting sector. So yes, you can be nuanced, I agree, on some of the deeply beaten up sectors, but really the trade's just begun, the investment story's just begun. It's just a pretty dramatic opening, that's all.
Well, let's talk about a couple of things you focused on there. Bond yields. In order to get confirmation of this move that we're seeing at the moment, do we need to see bond yields rising? Because at the moment, they're not really. The US is kind of 80 bips and change. We're trying potentially to get up to around 1%, but it feels like a real struggle. If we can't get there, does this move into value run out of steam?
Well, I think it does run out of steam, but it depends on your time frame, of course. But I'd say it's quite a good move already. I think it was 55 bips on the 10-year in the US back in, I think it was in August at its lows or July. And as you say, we're now 80 and change and moving higher. That's quite a significant move on terms of, percentage of the basis points up, if you like. But yeah, we need to get to 1. We need to get to 1.5. Look, I think the biggest risk to this equity market is not a steady move higher in bond yields. That would be terrific, but a dramatic move higher in bond yields sometime over the next 6-9 months, because it strikes me there is so much stimulus in the pipeline. There's so much cash in people's bank accounts, and there's such a high risk, I think, of inflation picking up and growth being super strong next year that bond yields at 80 bips just seem completely the wrong level to me. So I think, and by the way, on top of that, the positioning in markets is completely wrong. Everyone is long 10 years and 30 years and overweight that area. So, I think there's enormous amounts of risk that we have a repeat of a 1994 bond market sell-off or something like that. And I think that's the sort of thing that if it really happened and was dramatic, then I think we'd have some challenges for the equity market.
Can I just focus on the banks a little bit there? You talked about the European banks and people's antipathy for them. Philip Lane, the chief economist over the ECB, saying only earlier today that it is essential not to let the yield curve steepen prematurely. There is also this ongoing resistance, it seems, certainly at the central bank, the ECB, to allow dividends to be paid at this point. Aren't those two factors that would speak against necessarily wanting to own European banks?
Well, yeah, I mean, yes and no. I mean, I'd say no, because actually the one trade we've got on, or one of the trades we've got on, is a widening of US Treasury yields relative to bond yields. So, there's a much stronger case for Treasury yields to back up than there is in bond yields. So, I mean, bond yields will back up towards zero, but they won't move nearly as far as 10-year Treasuries, in my opinion, because the demographics are much more favourable in the States. It's a much younger population relative to the ageing population in the Eurozone. And there's much more of a consumer spending, consumer credit culture in the US than there is in the Eurozone. So the growth drivers are much better in the US, so the spread should widen. And actually, if you look at it, Eurozone banks correlate much better with US Treasury yields than they do with bund yields. So I would argue that bunds, because of the ECB, is somewhat an artificial market. It's not helped by the demographics. And yes, I understand what Lane is saying. I mean, clearly you don't want things to squeeze, you don't want the yields to back up and squeeze the recovery too quickly. It needs to be orderly. But, you know, it's just the same as saying they want an orderly currency market. I think the key here is what happens in the States and what happens to 10-year US yields out there.
Stick around, Chris. We need to talk about what is happening in the UK, Brexit, and also the spending review. That'll be next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Thomas Byrne, the Irish Europe Minister, just making some comments on Brexit. Brexit talks at a critical juncture, he says. I think I've heard that one somewhere before. Very little time left. I think I've heard that one as well somewhere before. Let's figure out where the markets are, though, when it comes to Brexit. Here are the details. Danny Berger.
Guy, I guess it's another crunch week for Brexit as well. This sort of roller coaster ride continues, and it continues to impact assets as well. Some speculation that we've seen over the past week that we were heading closer to a trade deal helped to send the pound up for 4 consecutive days. Well, that's now reversing. You can see sterling down about 4%, 0.4% versus the dollar. But I really want to point out this divergence we're seeing in the rest of Europe versus UK assets. They're mostly flat. Yes, trading is light. There's a U.S. holiday, but I think this continues to emphasize the dual risks that the UK has to deal with. The economy and the effect on the economy of COVID. The UK, of course, has been very hard hit, as well as these Brexit risks. And that divide you can continue to see what's happening in the cash sterling market versus what's happening underneath. And I want to dive into the charts for this because this really interesting divergence has been occurring over the past week. It's not this one, though. This is virus flare-ups in Europe, of course, relevant as well. But we've seen the pound continue to gain. It's at about a 3-month high, but 1-week risk reversals, those right now are at a September level of bearishness. In other words, the option market is saying the pound is going lower from here. It wants to protect itself against 1 week, whereas the cash market is not saying that. As Nordea's Sebastian Gailey said today, the cash market is not pricing in enough of the risk that we don't have a deal. There's the chart. There's that divergence, Guy.
Better late than never. Danny, thank you very much indeed. Danny Berger on what is happening with sterling. Do you believe the cash price, I guess, is the question. Does Chris Watling believe where we're pricing cash at the moment? He joins us from Longview Economics. Chris, do you sell the pound here? It seems we've got a bunch of risks coming into view for the UK economy. We still don't know what is going to happen with Brexit. We saw the dire economic projections from the Chancellor yesterday. Nevertheless, if you believe in the bounce back trade, I guess the UK could be well positioned.
Well, I mean, everyone's well positioned, so it's a relative game, isn't it? And of course, the UK has this special factor of Brexit that's had some influence on its currency. I mean, clearly the currency's rallied in part because the dollar's been going down against everything over the last few months. But I think Brexit's got its own sort of special influence here in the UK. And, you know, markets are very forward-looking, and really all the chatter has been, really, if you think about it, we're going to get to a deal. It's basically the implication. So I think the market expectation is relatively robust for a deal to come through. And no doubt we'll get a little pop on the announcement of the deal when it happens. I mean, who knows? As you say, it was supposed to be last week, it's supposed to be this week, and now it's supposed to be next week. But we'll probably get a small pop on that. And it's interesting, you know, we're at quite a key level for sterling. 134 is quite a level. It's been quite a resistance level a number of times over recent years, and we've really only been above it once over the last few years. So you know, we're quite close to that. Maybe we pop above it briefly on the announcement, and I think that's an opportunity to sell sterling, because I think fundamentally we don't look as good as we could look, and clearly Brexit's a bit of an impediment to growth in the medium term. And actually, we've performed very poorly relative to the rest of the world in terms of, you know, our COVID health response, but also our GDP numbers as well. We had some of the worst GDP numbers of the lot. So I'm bearish on sterling. It's become a consensus long. You know, the consensus sentiment's very bullish. So you want to lean against that. You've got an interesting resistance level, and I'm not sure the UK is going to be outperforming the US economy over coming quarters and years. So yeah, I would be looking to average into short positions on the pound versus the dollar.
Can I just come back to that issue of how beaten up the British economy has been by COVID? And part of that is down to the composition. There is a lot of consumption in the UK. There is a lot of hospitality. All of that has certainly suffered as a result of COVID. But in theory, therefore, that should make it one of the bounce back trades, shouldn't it?
Well, that's true. There's something to be said for that. But I just think also our approach to lockdowns and our approach to healthcare weren't very good. I mean, to be fair, they weren't that good in the States either. So you could make that argument there. But yeah, I just feel that there's some real issues that are Brexit related, London related, and I think there's some real challenges this economy faces. So it's yeah, of course, there's a bit of cash in bank accounts. That's going to help. But I think across the board, our general sort of governance, our performance of the government, I just think it was poor. And I think that adds to the reason to be negative, particularly when everyone's bullish, as I said.
How bad would a no-deal Brexit now be? It does seem as if you could put a very thin piece of paper between a deal or no deal. Manufacturing would certainly suffer, one of the areas that has actually stood up during the COVID crackdown. How bad would it be? The Bank of England is suggesting that it can actually be even worse in terms of its impact than COVID.
Well, I think there's some real challenges short term. Yes, you'll get all those queues, they'll get the paperwork. What will happen to the financial services sector? I mean, that already looks slightly out there, and a lot of uncertainty as to how that's going to pan out between the equivalence or non-equivalence debate, so to speak, between the City of London and European financial services. And I think with queues at the ports and struggling in terms of supply chains and challenges for a financial services sector in a no-deal Brexit, I think it would be a real issue for this economy over the course of the next 6-12 months. So that's clearly a very UK-specific risk that's pretty meaningful. I mean, of course, it has some knock-on effects on the Eurozone as well, but primarily it's a risk for this economy. So, yeah, I think it could be quite serious.
Chris, on that note, we will leave it. Thank you very much indeed for your input today. Chris Watling of Longview Economics. We're just getting some numbers through from Anna Cuomo, stateside New York, reporting 6,933 new positive cases. That being tweeted out just a moment ago. That's a pickup of around 1,000 versus yesterday. New cases for the first time picking up really quite sharply now. Hospitalizations now above 3,000. What do we got coming up for you? A brewing diplomatic spat over skiing. The German Chancellor Angela Merkel pushing for European ski resorts to be shut down this winter due to the pandemic. Not everybody's on board. We're going downhill fast next. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. So a diplomatic spat over European ski resorts is now brewing. The German Chancellor Angela Merkel basically says that they should all be shut down for the time being this winter to rein in the virus outbreak on the continent. Joining us now from Brussels is Bloomberg's Maria Tadeo. Not everybody agrees. How big an issue is this?
Well, they don't agree, and Guy, this would almost seem like a sketch. It would almost seem like a parody in the midst of a pandemic. We are debating whether or not to go skiing, but it is becoming an issue between four countries. That's Germany, Austria, Italy, and France. Now, the Germans, as you pointed out, they've made it clear they believe resorts should not be operational this year. Angela Merkel does believe that we could see a third wave after the Christmas holidays, and she's also pointed out that one of the lessons we should take from the summer is that opening up too much and too quickly is problematic. However, the Austrians say that they do not fully agree with this. They have taken the measures and they want to open. They also signal that if you are a resort and you're not able to open up this year, you're not able to actually do a normal season, you're going to turn to the state, and ultimately it's the government that's going to have to pay for this. It's also leading, Guy, to some surreal regulation coming out of European governments. Today, the French government said that they would go ahead and open, but just to give you an idea, the cable car that takes you top of the mountain, that would not be able to be operational as usual because it means too many people in a closed space. So it does have potential to run into a diplomatic issue. If one country decides to open, the neighbor says they don't want to open, but also it's just some of the surreal regulation that is coming out of this. It's also very difficult for people to follow, frankly.
Yeah. Okay, if you tell him, Mark, but for everybody else, probably not so good. Maria, I just want to turn to a more serious issue. This is serious, but there are more serious issues that Brussels faces right now. We are starting to get some comments coming through from Viktor Orban out of Hungary. Hungary won't accept the EU plan that Poland doesn't accept. There is commonality between Hungary and Poland, apparently. They've signed a joint statement on the EU budget. They are aligning their positions, saying as well that the EU must separate the rule of law debate from the spending plan. How does this get resolved? Because at the moment, the 7-year budget plus the attached rescue plan is going nowhere.
Yeah, it's going nowhere. And Guy, that December 10th meeting, it's looking harder and more complicated by the day. There's a lot of issues that European leaders will have to deal on that day. Now you're looking at a potential veto on the recovery fund, on the European budget. This is extremely, extremely problematic for the Italians and for the Spanish. They've made it clear yesterday to those two countries that they do want to see this recovery fund operational by January. Now, how do you solve this? It's difficult because Poland and Hungary are simply restating positions that they already said they have, that they want to see a separation between the funding and the rule of law, that they see one as just being purely economical and the other one is about politics and ideology. They don't agree with this liberal view of the world, but for the year.
As you can see, position closed on Japanese yen. Right here. Okay. Right. This. Okay, position closed, and have £500 in profit. All I can say, it's worth something to keep your holding overnight. Plus, if you know when you trade on margin, if you sell short, you don't have to pay overnight charges. Broker pays you. Well, if you don't know, you can get the strategy, and you will find everything over there. Basically, it's explained how it works. So, get the strategy and start making a profit for yourself.
In our interconnected world, if people in low and middle income countries miss out on vaccines, the virus will continue to spread and the economic recovery globally will be delayed. Equitable access is in the national interest of each and every country.
But this also means if we have a vaccine, we should have a common approach to give a fair share to everyone so that the most vulnerable groups, the frontline workers and the healthcare workers, for example, are the ones who get the vaccine first.
We're donating another $70 million to fight COVID-19. $50 million of that will be for buying vaccine doses for low-income countries, and another $20 million will be for researching even further and new vaccines altogether.
Il nous faut nous assurer que les conditions réglementaires et politiques sont toutes réunies pour un accès le plus large et rapide possible à ces produits, tout en respectant les standards internationaux de qualité. C'est pourquoi la France propose que puisse être rapidement adoptée une charte d'ACTA qui réaffirme ces grands principes: partager la connaissance, soutenir les systèmes de santé, avoir des produits rapidement accessibles et abordables.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. So, European credit markets are striking an upbeat note today on rising optimism that the end of the pandemic is in sight. Risk gauges for both the investment grade and high yield debt are retreating. We'll continue with the spread compression. Peter Chatwell, Mizuho, head of multi-asset strategy, joining us now. Peter, let's talk about the sustainability of this move. It's interesting. So over the last few days, we've seen Carnival be able to come to market and raise money unencumbered. It was able to do it without having to put ships up as collateral. Lufthansa was in the market as well, raising money and doing relatively well. I'm wondering whether or not you think that these are sustainable trends, and you worry that the kind of the long, hard winter we're all facing could undermine them.
The way I see it is the vaccine was the key turning point here. That means the prospect of societal normalization in time for summer of next year is very high. So that means that the COVID-afflicted sectors, such as Carnival, such as Lufthansa, they really do have the opportunity to get back to some sort of normality on their top lines. But what we then need to see and really assess over the course of at least the first half of next year is these accommodative financial conditions. Are they going to be used correctly? Are they going to be used for balance sheet repair? Or is it just going to be a case of loading up on more debt? If it's the latter, then what we'll have is a rally in the first half of next year, but then it will stall out. What we think is that there is going to be a significant amount of balance sheet repair, and that is going to mean that credit markets can continue their outperformance of equity markets, and then they'll go and reach the tightest spread since the great financial crisis.
In terms of the danger around that thesis, a lot of companies, as you say, have raised an awful lot of money already, and there is this fear that if the economy doesn't pick up sharply enough, that balance sheet repair will not be viable, and as a result of which these companies are not really going to be able to cover their costs on the credit side. How big a threat is that, and how granular are you going to need to become in terms of picking individual credits and working out kind of who is going to be able to manage it and who isn't?
That's a super question. And I think the ECB will have a major role to play in assessing the type of financial conditions that they're creating and whether or not it's turning to be problematic, whether or not the incentive structure is incorrect. Now, it will mean that the value in real detailed digging and analysis of a corporate balance sheet comes right to the surface. That's going to be where the alpha generation is next year. And I think there's going to be a lot of performance from beta if our thesis is right, but really to add alpha to that, fundamental credit analysis is going to be super important next year.
Okay, so where do you see the areas that you want to be? Get granular for me, both at a sector level and maybe even down to individual credits, because there is a lot to choose from out there, and it's pretty clear that COVID has accelerated a bunch of trends that are going to have a meaningful impact on business models.
Well, if I look at the risks that are facing us now for next year, I have to say that COVID is not one of those, or it's just a small component of that. And I have that feeling of confidence because of the vaccines. And really the only risk I see, which could add COVID coming back onto the radar, is if vaccines are not accepted by society, if there's a big anti-vaccine movement. Otherwise, the main risk factors I see are actually about geopolitics, about the the possibility that corporates don't do the right thing and repair balance sheets. And so actually, I feel very comfortable in picking the COVID-afflicted sectors. So let's take airlines as an example. I think that the recovery for those will continue. And so I like those sort of themes, and I would recommend long in the COVID-afflicted sectors and names, and then I would recommend doing those positions, being long those positions against the low betas, looking for continued spread compression. And I think that's going to be a theme for the first half of next year. It's just had about a month of really good performance. I think it's got a long way to go yet, probably 6 months.
Well, let's just stay with this theme then and think about what is going to happen. One thing that COVID has changed is businesses' appreciation of how many times they need to put their people on the road. Airlines make traditionally a lot of their money at the front end of the plane, particularly those that cater on the North Atlantic, for instance. And even if we see 20 to 30% of that business disappearing, that is going to have a massive impact on the ability of these businesses to make money. How does that factor in? The pandemic has changed a lot of behavior, and some of that behavioral change is going to stick.
Indeed. When we've done our analysis, we have not assumed a normalization of top line for the afflicted sectors at all during 2021. What we've done is we've looked at their revenue paths, and we've assumed that we've forecasted a revenue path based on our macroeconomic assumptions and forecasts, which doesn't see their revenues getting back to normal towards 2023 for some of the afflicted sectors. And taking that into account and looking at where they can raise debt, where they can issue equity if they choose to, that's how we still come to this picture of outperformance for many of these sectors. Really, we're looking at probably the lowest risk ones as being the best value right now on a market neutral basis.
Peter, talking to people I know in sales before the crisis, they were flagging to me that some of the stuff that was going out of the door, the covenants that were attached to them were really not designed to provide really that much protection to investors. Very, very light covenants being applied. And I wonder, as we go through a kind of rolling period in which defaults may not spike as they traditionally have done, but just continue at a more elevated level, which is, I have to say, probably looking more and more likely. How protected are investors going to be in terms of recovery rates? What do you see recovery rates looking like?
Well, so far, recovery rates have really surprised to the downside. And I think that's the point you make there is extremely valid. And it's why doing your full fundamental and legal research on the higher risk names is absolutely crucial here. So the way I think next year is going to pan out is that there is going to be this selection process whereby if you are not overly financially engineered, haven't issued these covenant light structures, and simply trading at a wide premium because of the sector you're in, or you've lost an IG rating and have gone into crossover or slightly wider into high yield, but you're still viable once society normalizes, then those are the businesses, those are the names which are going to perform, I think, really in quite a powerful way first half of next year. But we're still going to have this backdrop in the weaker names, in the triple C kind of area, where there is still going to be a lot of risk, and we're still going to be realizing quite elevated default rates with quite low recoveries. And I think that's just a fact. But don't forget the amount of investors there are with very deep pockets that are going to be chasing returns, and particularly in European fixed income, because the story for next year is not just about the return to relatively normal spreads for much of the credit market, but it's also about the cyclical recovery in many currencies, the euro being a key one for that. So as the euro appreciates, more and more investors are going to be coming into European assets. And that's going to mean the wall of liquidity, which has been chasing European assets in the past 6 months, is going to be growing. So we may well have a degree of mispricing actually developing over the course of next year.
Tighter spreads to come. Peter, thank you very much indeed. Peter Chatwell of Mizuho. What have we got coming up for you now? AstraZeneca and Oxford facing mounting questions over their COVID-19 vaccine candidate after acknowledging a manufacturing error. We're going to talk more about this next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Hi from London, I'm Guy Johnson. This is Bloomberg Markets. Happy Thanksgiving. Let's check in on the Bloomberg First Word News. The coronavirus resurgence is making it an unhappy Thanksgiving for many in New York. Almost 7,000 cases reported in the last day, and hospitalizations are now over 3,000. In the United Kingdom, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed in Tier 2. That means that pubs, restaurants and bars can open for business, but alcohol can only be served as part of a meal. Households will not be able to mix indoors. And the Trump administration is considering a move that could boost transatlantic travel. Several agencies have urged the White House to lift an entry ban on non-US citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the formerly lucrative transatlantic market. Global News, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's stick with the virus and vaccine development. Development questions mounting over AstraZeneca and Oxford's vaccine candidate after they acknowledged a manufacturing error that affected trial results. Joining me now with more from London, Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. I'll get that out. Sam, save me. Who messed up here?
Somewhere between the Oxford vaccine group and the manufacturer, which obviously involves the people who make the viral doses and then fill and finish them. Somewhere in that group, somewhere, somehow, possibly involving the clinical trials organization, if there was one involved, that's where it's gone wrong. What is nice to know, I think that's what we know, is that it wasn't like a batch was made and then it was only half active. They literally gave people a vial which had half the dose in it. If it was that issue with the half active, then that's a bit more concerning. But I don't think that's the case. So Astra, I don't think can really be thought of as anyone as really that guilty here.
And in some ways, this was serendipity. It allowed a higher efficacy rate to be generated. How will this problem with the dosing, do you think, affect acceptance of the vaccine? There was much criticism earlier on this week from the United States, some suggesting that it wouldn't be given approval there.
Yeah, so I'm not going to go as far as you have. This hasn't proven anything. Once you know much more about that group of people who apparently gave you 90%, I'm choosing my words very carefully here, apparently gave you 90% efficacy, then we can start deciding whether it was the half dose, full dose thing that drove it, or whether it was because there were younger patients, because there were healthier patients, or because we just didn't have enough numbers in that group. So that's where I think we have something that we still have to figure out, which is why I suspect there's all this question marks, not just from the US. I think from the get-go, we were also skeptical.
So what needs to happen? How does this need fixing? How does it get fixed? And how does it get put right?
Right. So this combined group of Brazil and the UK trial had up to about 23,000 people in it. What we can do is get to the end of it, subtract the half-dose, full-dose people, and go to what the trial was designed to test, which was, in fact, the opposite hypothesis, high dose followed by low dose, and also 2 high doses, and see what that tells us. And then see if this other group has any other reasons to explain the 90%. If it does, you go back and redesign another trial and test that. You can't run away assuming that half dose plus full dose is what we should give people. You can't make that decision for 2 billion people on the basis of a 3,000 patient outcome.
In terms of why this is important and to get an idea of the scale, how much of the world is relying on this type of vaccine, the J&J vaccine, as opposed to how much of the world is likely to rely on the newer mRNA vaccine, which has the issue of stability and temperature?
Yeah, so I've said this a few times, Guy, and I've probably said it to you on your show as well. You know, we put satellites into the sky and put people on the moon and exchange amazing things with the International Space Station. I'm sure we can solve the logistic problems of shipping something at -70 and -20 if we put our mind to it. The Ebola vaccine needed those kind of temperatures, except that they were given to far fewer people, but still they managed it in the Congo. So I'm sure it's doable. The point is, obviously, we all need less. It would be much easier to have a vaccine you can just put in your pocket and take around. So today, the United States has sufficient doses contracted and -20 with Moderna and Pfizer to cover its population and more.
Is very high.
The UK and the European Union and the rest of the world are currently dependent on the Astra vaccine. So that needs to get sorted out. But in due course, we'll get news from Johnson & Johnson, and we'll get news from Novavax, and find out whether those vaccines are, how effective they are. And once we have that, we can start thinking about how quickly UK, Europe can open versus United States versus elsewhere.
Yeah, it's going to have critical economic impact. Sam, always appreciate your time. Thanks for joining us. Sam Pazzelli of Bloomberg Intelligence. This is Bloomberg.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Live from London, I'm Guy Johnson. This is Bloomberg Markets. Time now for a Bloomberg Business Flash, which is a look at some of the biggest business stories in the news right now. Let's start with Disney, which has announced 4,000 more job cuts after virus lockdowns forced the closures of its theme parks. That takes the number of layoffs set for the next 6 months of next year to 32,000. That's more than 10% of its workforce. The coronavirus pandemic has hammered Disney's traditional businesses, of course, like studios, parks, and cruises. The Spanish oil producer Repsol is going green. The company says it intends to wind down the search for oil and expand its renewable capacity by fivefold in the next decade. Repsol was the first major oil company to set a net zero emissions target. It did so a year ago. And the second largest mall in the United States is getting its first big test starting tomorrow on Black Friday. The $5 billion American Dream Complex opened its retail stores last month. The timing is, well, less than perfect, though. The coronavirus pandemic has driven more shopping online, of course. Plus, the American Dream is built around experiences. Its indoor ski slopes and water park, well, they no longer hold the same appeal. And that's your Bloomberg Business Flash. Nice to go skiing. Looks like we're not going to see much of that in Europe, at least for a while. Let's turn now our attention to what is happening in the real estate market. I guess it's a linked theme. The amount of construction on new office space in central London has plunged. The figure halved in the 6 months through to September, according to Deloitte. Here with a look at this commercial market is Bloomberg's Danny Berger.
Guy, we know that a lot of companies have really been turning in and giving up a lot of their office space with more workers cocooned at home. But what's starting to emerge because of the coronavirus is this very strange bifurcation of the London real estate market. And this is really a global trend as well. But what's occurring is because there's so many yield-hungry investors out there, real estate is, of course, a great place for that. anything that can still command high rent, it's seen its value grow. At the same time, older office space has seen its value lessen. So we're getting more of a divergence in these different markets. And it's turned real estate into a market that's really all about quality. You can't just really buy any more undervalued property thinking you're going to get a good return on that, because workers won't necessarily come back to those offices. Instead, what's important now, it's about quality, it's about ESG, it's about top amenities that'll bring people back into the office. I spoke earlier with LaSalle Investment Management's Europe CEO, Philippe Lapierre, exactly about this topic. Here's what he had to say.
We don't believe the office is dead. However, the near-term outlook for the office sector is going to be, a lot less certain as it was prior to the pandemic. The longer-term piece is going to be that much more interesting, and you'll probably kind of need almost a social psychology study on human behavior to see how people return to work. And the one statement that I like with that is, work is no longer a place. Work is now a more diffuse picture.
I love you said you need a sociologist study done on the market. That's how complicated it's become to find valuable real estate, but the demand is certainly still out there for that flight to quality, Guy.
That makes it presumably a much more specialized asset class.
It really does, and not just for investors, which maybe still will have the same demand because of that yield, but for these investment management firms themselves, they need to get more specialized. We've seen more big firms buy up boutiques, and presumably to do just this, it's getting more complicated, and you need a different skill set to really find attractive offices.
Danny Berger, thank you very much indeed. Danny, on the retail sector, I just want to return to the issue we were talking about just a moment ago, and that is AstraZeneca. Some breaking news coming through from Pascal Soriot, who is the CEO of AstraZeneca. Pascal saying that Astra is likely to run a new global COVID vaccine trial, and that probably is going to mean the clearance from the FDA is likely to take longer. Astra saying the new study will be faster, though, and need potentially lower numbers of patients. Nevertheless, a little delay now looks likely in terms of approval for that Oxford vaccine, certainly over in the United States. We're going to carry on the conversation over the next hour. We'll talk more about what is happening with the global economy. Janet Henry, HSBC's global chief economist, will be joining us, as will Vincent Juvens, JP Morgan Asset Management Global Market Strategist. That's all coming up. This is Bloomberg.
Side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that is even more difficult to control than the technology of the period then.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
PM in London, 11 a.m. in New York. From London, I'm Guy Johnson. US equity and bond markets, of course, closed for Thanksgiving. Happy Thanksgiving. Welcome to Bloomberg Markets, everybody. Quick look at where financial markets are with US markets closed. Light volume, obviously a theme across most assets. The Stock 600 now negative, but not by much. SPOO's also in a similar position. Below the surface, though, the rotation back towards tech continues. That's where we're seeing the outperformance here in Europe. The auto sector, the energy sector, etc., underperforming a little bit. Euro dollar has a 119 handle, though it is off its highs. And we're starting to track towards some areas where previously we have had some concern from the ECB, i.e. 120. And Bitcoin now trading with a 16 handle, 16,863, a 10% downdraft after that huge upswing we saw in the price. The virus, though, remains front and center, as does the race for a vaccine. And AstraZeneca's candidate front and center. It now, though, may take a while longer. This after questions were raised over trial results. The company's CEO, Pascal Soriot, telling Bloomberg within the last few minutes that it will now likely, as a result, run a new global trial, saying, quote, "Now that we have found what looks like a better efficacy, we are going to have to validate this. So we need to do an additional study." I.e., it looks like it's going to be half dose, full dose, that could produce a much higher efficacy than maybe a full dose. Meanwhile, Europe and the United States continue to struggle with containing the virus resurgence. Germany is seeing a record increase in new cases, while New York cases are approaching 7,000, hospitalizations hitting their highest since June. Let's deal with the details now. Here with those, Bloomberg's Emma Chandra.
Thank you very much, Guy. Yeah, a little bit less rosy virus news today after a week in which we had seen what was seen to be good news from AstraZeneca on their vaccine. Today, hearing, of course, that they have to, they're going to look to have another global trial of that vaccine to test this efficacy of the dose or the half dose, full dose that they think will be better. And as you mentioned there as well, getting some more troubling figures out of large economies, the likes of New York, also of Germany, about the level of cases. As you said, in New York, we're seeing some nearly 7,000 new cases in the last 24 hours. Hospitalizations topping 3,000 in New York. Over in Germany, setting a record for the number of new cases in the last 24 hours. Some 32,687 new infections. As I said, that is a record increase in Germany. Cases tripling since October there, and looking at the number of cases approaching 1 million in Germany. And for that reason in Germany, we're not seeing any easing of its partial lockdown restrictions. They are going to stay in place, Guy, until December the 20th, so right up until Christmas. There is a bit of a different story when we look at some other countries in Europe. We do have a Bloomberg chart which should show you how new cases are starting to fall off. We're starting to see a reduction in the number of new cases when we look at the likes of France, Italy, Great Britain and Spain, and therefore there's a slightly more positive story there as we start to look at some easing of restrictions in those countries, Guy.
Yeah, we are seeing that easing. So let's walk through the details of that. We heard from Emmanuel Macron earlier on in the week. Today we got the details of the UK tiering system as the UK's partial lockdown ends next week. Walk us through what we know.
So what we know about France is that their lockdown will end on the weekend, this Saturday. President Emmanuel Macron announcing that earlier this week. In the UK, that data, or the news, very much coming out today. The lockdown in England, remember, in the UK, we have to look at the different nations and regions. So the lockdown in England ending on Wednesday and going back to this tiering system. But what's interesting there is that London has avoided the toughest restrictions. It's gone into tier 2. That means some services like pubs, like restaurants, like hair salons, they can reopen, though there'll be no mixing of households, Guy.
Yeah, I think very few places in the UK now look like they're going to, or England are going to end up in tier 1. The Isle of Wight, Cornwall, and I think somewhere else as well. Only 3 areas.
The Scilly
Emma,
Isles,
thank you very much.
The Scilly Isles.
The Scilly Isles. How could I forget the Scilly Isles? Emma Chandra, always has all the details. Thank you very much indeed. Joining us now, Janet Henry, HSBC's Global Chief Economist. Janet, we are seeing, as Emma pointed out, case counts starting to rise. And the US is celebrating Thanksgiving today. That comes with mixing and travel, and as a result of which, we're likely to see a significant spike in the case count. Hospitalizations are also rising. How is this factoring into your thinking about how the recovery and 2021 is going to look economically?
Well, we need to balance, obviously, the good news on the vaccine front. Clearly, there's been some mixed headlines today, but compared with where we were about 6 weeks ago, there is no doubt that the broad news on a vaccine, the certainty that at some point in 2021, we will be some way towards containing this pandemic, against what are obviously some fairly big negative downside risks for the very near term. So, yeah, there's light at the end of the tunnel. It's just that this valley that we've got to cross in terms of the weakness of activity, if anything, looks set to be a little bit longer. And certainly that's been the message we've been getting from the likes of the Fed and the ECB at the moment. If anything, they're positioned for near-term downside risks rather than getting carried away about the optimism regarding the vaccine.
So what does that mean in terms of policy between now and Christmas?
Between now and Christmas, central banks are going to do more. We've known for some time that the ECB, there's nothing that's going to stop them from recalibrating all of their measures. Well, not all of them. We don't think they're going to go to more negative rates at this point, but they will be delivering some kind of package of measures in December. And I think it was pretty clear from the Fed, not that they're going to up the degree of insurance that they talked about yesterday, but that they will continue the asset purchases. So the total amount of monthly purchases of 120 billion a month, if you include obviously not just the government bonds, but other securities as well, that they will continue into next year. And I think that was further emphasized by Philip Lane today. You know, he's very nervous that the good news on the vaccine might actually cause the yield curve to steepen a bit too quickly, and that, you know, that might impact a bit more quickly than the what's happening on the real economy and for households and for companies. Central banks still ready to do more, and certainly to keep monetary accommodation in place.
Janet, we seem to have had a little issue with your screen, but we'll carry on the conversation. The story on fiscal on both sides of the Atlantic seems to be stalled, both in the United States and here in Europe. Here in Europe, it's Hungary and Poland that seem to be holding it up. Over in the United States, obviously, it is the politics between the Democrats and the Republicans. Will the central banks fill that gap, and are they capable in reality of doing so?
No, central banks can't fill the gap. Obviously, even before this pandemic, we knew that central banks broadly were running out of ammunition. They played a critically important role in terms of unlocking financial markets at the start of the pandemic. They played an equally important one subsequently. But it was very clear in the ECB accounts today, they are playing a supporting role. The heavy lifting everywhere has to come from fiscal policy, but they are taking their supporting role very seriously indeed. The lead role has to come from fiscal side, is coming through in Europe. And admittedly, the Fed is probably frustrated that anything they're likely to get in the next few months or next few weeks from the US is going to fall short of what they've actually been advocating in terms of the scale and the mix of fiscal stimulus. So no, the central bank support is very much a supporting role.
Was that what we saw today, though, in some ways from the Riksbank? It understands that it can't do what fiscal can do, but nevertheless it appreciates that there is still a great deal of uncertainty and there is a need to get in front of it. We don't know what's going to happen. There was a fear maybe in the market first thing this morning that the Riksbank was signaling it knew something that the rest of us didn't. But is it just as simple as maybe the Riksbank just wanting to get in front of the story?
I think that is partly it. I mean, we've heard it not just from the Riksbank, but we heard it from the ECB, we heard it from Philip Lane, some signs of a tightening of financial conditions. And, you know, as much as we can kind of look across the valley and hope that at some point the vaccine comes through and we get a more meaningful recovery, we know that the scarring on the economy will be determined by how deep this weakness in activity, how deep this recession is, and how long it lasts. So the last thing that they can cope with at the moment is an unwarranted tightening of financial conditions. So yes, to your point, it is about getting ahead of the story, but making sure that governments do too. You know, everyone looks back with hindsight on what happened in the wake of the global financial crisis, where arguably across Europe, fiscal policy was tightened too quickly. And I would argue even in the US, with the degree of state tightening because of the balanced budget requirement, policy was maybe even tightened on the fiscal front there too quickly, prematurely. So both for central banks and for governments, it's the same message. It's way too early to think about I suppose reining it in anytime soon.
Janet, stick around. It would be great to talk a little bit about also what we learned from the US data this week, particularly that claims number. Janet will be back in a moment. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Minutes past the hour, live from London. I'm Guy Johnson. This is the European close on Bloomberg Markets. Happy Thanksgiving. Let's check in on the Bloomberg First Word News. In the UK, London will avoid the toughest coronavirus restrictions when England's partial lockdown ends next week. The city has been placed into Tier 2. That means pubs, restaurants, bars can open for business, but alcohol can only be served as part of a meal. Households will not be allowed to mix indoors. A divided US Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. Cuomo wants to hold down crowds at synagogues and some Catholic churches in parts of New York that are COVID hotspots. Justices voted 5-4 against the limits. Chief Justice Roberts joined the court's liberal wing in dissent. Meanwhile, New York is reporting today there are almost 7,000 new infections. And AstraZeneca is likely to conduct another global trial of its coronavirus vaccine. Current studies raise questions over its level of protection. The new trial will evaluate a lower dosage that performed better than a full amount in Astra's studies. The lower level was actually given by mistake, hence the new trial. Global News 24 hours a day, on air, and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's turn back now to the United States, the economic data and the Fed. The FOMC yesterday releasing its minutes. That was of the November meeting. From the November meeting, officials discussed updating bond buying guidance fairly soon, but saw no need for immediate adjustments. Still with us, Janet Henry of HSBC. Janet, this obviously predates the 2 weeks that we've had of rising claim counts in the United States. The labour market is starting to take a turn for the worse stateside. Are we setting ourselves up for a significantly worse payroll report? And if so, do you think that could sway the Fed to do more?
You're right, we have seen a slight creeping up in terms of the jobless claims. Also importantly, we've seen in the latest release some drop in household incomes. So, it was already clear that the fiscal stimulus that was initially delivered was starting to wane. We are now seeing that start to feed through. It may not be material enough yet for the Fed to actually up the pace of purchases, the monthly rate, but certainly it is enough to continue at the current rate, not just to the end of this year, which we already knew, but to extend it into next year. In terms of the payrolls release, it's a little bit early. We'll have a better idea in the next few days. But certainly it is pointing to a softening in the rate of improvements in the payrolls. I mean, it's been the big surprise, I suppose, in the course of the last 6 months, just how quickly the unemployment rate was falling. It was already set to slow. It would appear that, maybe we see this leveling off pretty much immediately.
Janet, one of the things that's being actively discussed at the moment is that if the Fed were to act, the way that it would act would be to buy more long-dated bonds to try and flatten the curve. I understand the market effect of that, i.e. a flatter curve, and the kind of the spin-offs from that. I'm wondering what you think the economic impact of such a move would be.
Well, I think it does feed through into broader financial conditions. And obviously, the way it feeds through to the average person in the US or elsewhere, where mortgage rates are tied to long-term interest rates, is obviously through the housing market. Now, one of the surprises in this pandemic, compared with what people might have estimated last March, is that housing markets in many countries in the world have been remarkably robust, particularly if you're not buying apartments in city centres and such like. So it would be supportive in that sense in the real economy, broadly in parts of the housing market, which, although they've been very resilient, may not be quite as resilient in a world where we might see more permanent job losses creeping through in the course of 2021. So that is one of the main implications. Also, it obviously feeds through in terms of corporate financing. Spreads have obviously not widened, but in some concern about growing defaults as a lagged response to the depth of the recession that's come through. Anything that prevents those financial conditions from tightening prematurely, that will as well feed through to the real economy. And obviously the shift in asset purchases towards longer dated purchases is something that we've already seen from other central banks, for instance, the Bank of Canada.
Just before we wrap up, can we have a quick conversation about what's happening here in the UK? We saw a spending review yesterday. Within that was an effective public sector pay freeze, excluding the healthcare sector. But there have also been hints recently from the Chancellor and others close to him that we could also be lining ourselves up for tax hikes. Do you think it's too early to consider public sector pay freezes? Do you think it's way too early to even be thinking about, talking about the possibility of putting taxes up?
Well, these are all political choices, and obviously there are certain things that have been ring-fenced in various manifestos, although people will question whether manifestos should be stuck to in a pandemic world. But I think there are probably, we know that ultimately a consequence of this pandemic and the rise in debt is that it will ultimately mean higher taxation. So I think there are probably some areas that can be approached over, in a relatively short period of time, maybe in 2021. In the UK, maybe we even get those first moves in areas related to wealth, whether it's capital gains taxes or other areas taxing higher earners could start to come through, but potentially it might just be a commitment to what happens in 2022. So perhaps it's a little bit early to be making the comment at the same time when actually what was announced yesterday was another big increase in spending rather than anything on the taxation front. It could dampen confidence, it can affect savings behaviour and therefore economic activity and even investment intentions at an earlier stage. So arguably it is a little bit early. We know that it's very important to ensure that the economy is on a sustainable growth path rather than looking to consolidate too early. It's just that, what will be the new long-term growth path, we really don't know at this point because we don't know what the full extent of the scarring is going to be from the rise in structural unemployment and the hits to investment spending and particularly to productivity and such like. So it's pretty early to be making bold calls about the timing for fiscal consolidation to come through.
Janet, always a pleasure. Thanks for spending some time with us today. We greatly appreciate it. Janet Henry of HSBC. We'll talk to Charlie Bean of the OBR a little bit later on in the programme to get his take on all of this. Coming up as well, we'll be back to AstraZeneca. AstraZeneca now looking as if it's going to conduct another global trial of its COVID-19 vaccine candidate. This after questions were raised about the level of protection being provided and the way that the studies have been done with the various dosing regimes. Bloomberg conducting an interview today with Pascal Soriot. We'll get details of that interview in a few minutes' time. This is Bloomberg. Live from London, I'm Guy Johnson. This is the European Close on Bloomberg Markets. So as we've been hearing, AstraZeneca now likely to conduct an additional global trial to assess the efficacy of its COVID-19 vaccine. This after current studies raise questions over the level of protection and the dosing. Joining us now to talk about all of this is Susie Ring, who has just conducted an interview with the CEO of AstraZeneca, Pascal Soriot. What did we learn? What did he say about what happened with the studies that were conducted and the dosages? Kind of how much clarity do we understand around what went on?
He said that it shouldn't be viewed as a mistake. Ultimately, they did have a lower dose than they expected that they gave to participants, and they looked at that, and rather than deciding to scrap, those participants from the trial. They had discussions with regulators. They had discussions with each other and decided to keep them as part of the cohort. Now, they didn't expect that group to have a higher efficacy rate for sure, but now that that's come out, they don't see it as a mistake or a bad thing. They see it as evidence that they can do further studies to show a higher efficacy rate if they can get more data on that dosing level.
What I just read suggested that this was going to be a global trial. Is this a global trial, or is this a trial aimed at achieving FDA clearance?
It is a global trial. They had said on Monday that they would likely add an arm of a trial to the US because the US trials haven't been completed yet, and that they were planning to discuss with the FDA this week how they would do that as a way to kind of shore up this higher efficacy number. What Pascal said today, which hasn't been said previously, is that they actually think they will probably do a global trial, I imagine, because they want to make sure that they can have no question of the ultimate efficacy rate that comes out from that lower dosing regime. So we would expect now them to set up in the near future this second arm, not just in the US, but globally. And that would also help in terms of diversity and demographics.
Okay, well, let's talk about that. There were some questions as well surrounding whether or not there was a significant or suitable component of the trial that was in an older age cohort. Did he say anything about that and how they're going to correct that?
So again, that would be addressed by these new global trials. The cohort that got the half dose, that wasn't originally intended, but they followed through with, only went up to age 55. So that obviously means we don't know anything about how that lower dose would react in older people. This global trial would look to address that. So what we'd be expecting them to do is to have a range of ages, a range of ethnicities, exactly what we've seen from the other trials, to firm up, was this just a fluke? Was this just because younger people can respond better to vaccines, or is this actually a lower dose, a more effective vaccine?
Susie, will this affect approval in Europe?
Pascal believes not. He thinks that the vaccine is still on track for approval potentially by the end of the year, both in Europe and the UK, which is what he said previously, and he's standing by that. They have this lower efficacy rate, which still comes above the FDA benchmark of 50%. They had the 62%, so they believe they can get approval on that basis. In terms of the US, they had acknowledged that things will probably be slower, which was always actually a question mark because they didn't know how much the US would need US trials to be completed for them to get approval. This has added an additional question mark to that, so that probably will be slower. However, he doesn't think it's going to lag too much, he said today.
Susie, nice work. Great interview. Thank you very much indeed. The European close is next. This is Bloomberg.
Well, as you can see, we closed position on euro at 119.07. So we have £1,500 in profit.
For big decisions. We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
30 seconds ago until the end of regular trading here in Europe. A quiet session, understandably, with the United States celebrating Thanksgiving. We are seeing light volume. But let me talk to you about what we have seen. A fairly flat session at a headline level. This is the Stock 600, as you can see. Absolutely flat as a pancake versus where we started this morning. Pushed higher first thing this morning, faded, and then basically a track sideways with very light volume. In terms of the individual markets around Europe, again, very little action here. And we're seeing similar things over in the United States. I appreciate the market's closed, but futures are giving us a good indication. The FTSE 100 down a little bit more than most, and we are seeing a little bit of a rotation away from some of the winners that we've seen of late at an index level. For instance, Madrid down by 0.6%. The DAX, which has been a relative recent underperformer, outperforming today versus Madrid, which has been obviously hammered hard this year, bouncing back over the last few days on the vaccine news, today getting faded a little bit. In terms of other asset classes, pay attention to what is happening with the euro dollar right now. Philip Lane, the chief economist of the ECB, highlighting a tightening of financial conditions, a suggestion maybe that the ECB will step on any steepening of the yield curve. Keep an eye on further commentary over the next few days. We're trading 119. Remember, 120 was a line in the sand where Lane started to get very animated before, suggesting that that currency appreciation was a problem. We are seeing a bit in the bond markets today. Again, the commentary coming through in the accounts of the ECB suggesting potential further action, and that certainly seems to be benefiting the European bond market today, as you can see. So yields moving lower, prices moving higher, and Brent crude retreating a little bit after a very strong recent run, 47.78. The narrative in terms of the sectors, we're rotating back into technology, the more safe end of the market, certainly benefiting on the bid today. We are seeing banks under a little bit of pressure, energy stocks as well. Repsol, actually, the Spanish company, down for different reasons today, cutting its dividend, but nevertheless, Repsol becoming one of the first major oil companies basically to signal that it's done with oil in certain respects. It's going to boost its renewables footprint by 5-fold. It's going to cut its dividend, I say, for 2021. But the Spanish energy producer really looking for a green future, and green hydrogen, certainly an area that it wants to focus on. Montepaschi, we are back talking about the world's oldest bank, the Italian lawmakers, putting a bit of sand in the cogs, aiming to delay the government sale of the bank. That stock limited a little earlier on to the downside, halted, now trading down by 3%. And Flutter is the Irish-listed betting company. It's going to move into the Euro Stoxx 50. This is Unilever moves out. The reason for Unilever moving out is that it's moving out of the Netherlands, and therefore, in some ways, no longer eligible. And I want to finish up with the stock that we've been talking about so much throughout the show, AstraZeneca. Pascal Soriot speaking to Bloomberg's Susie Ring over the last hour, suggesting that we are going to see a new global trial for its Oxford vaccine. This on the new dosing, the lower dosing regime, which is half dose, full dose, and maybe a delay, therefore, in terms of FDA approval. But AstraZeneca bouncing towards the back end of the day, as you can see on the back of that interview, finishing down by just 0.2%. Vaccine news will remain front and center, it seems. BNP Paribas chairman Jean Lemierre says the news of a vaccine is, quote, light at the end of the tunnel, but the market shouldn't get too exuberant. He spoke to Bloomberg's Francine Lacqua a little earlier.
There are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time. But at least there is a light, and that's what is very important. I think this is well understood by the market.
Joining us now to continue the conversation from Brussels, Vincent Juvens, JP Morgan Asset Management Global Markets Strategist. Vincent, the chair of BNP Paribas, saying there is light at the end of the tunnel, but be careful. Would you agree with that sentiment? What do you make of this rotation that we've seen that really started back on the 9th with the Pfizer news, but has gripped markets ever since?
Yeah, I guess it's still time to be prudent, and obviously for the chairman of BNP speaking from France, where obviously restrictions remain in place for the foreseeable future and also well into the holiday season. It is clear that in Europe, contrary to our US friends, we are looking to a holiday period which will still remain depressed in many ways, even if indeed the vaccine offers some light at the end of the tunnel. In this context, I believe it's too early to call for the start of the great rotation. And if anything, the movement on the market today give a bit an idea of what to expect in the coming month. We had a cyclical rebound of that value stock over the last couple of weeks. We find it relevant from a cyclical perspective, but we should not forget that there are obviously structural headwind for a big pocket of the value segment. I'm thinking about the energy sector. You just mentioned Repsol, which is moving away from fossil oil to renewable, but clearly the energy sector, traditional energy sector, is going to struggle in the coming month and year due to this decarbonization, due to the fact that the economy will take time to recover its 2019 level. That's one thing. The other big heavyweight within the value indices is obviously the banking sector. And you mentioned it in your introduction, Guy, as well. Obviously, each time that you see any steepening of the yield curve, you will have an intervention of the central bank to ensure that financial conditions remain attractive for everyone needing to finance itself on financial market. States, obviously, but corporate need those easy financial conditions as the environment remains quite challenging at the moment.
What about the energy sector? It was interesting, I was talking as well about Repsol, the Spanish energy company, making a huge bet in terms of a move into green and green hydrogen. It's cutting its dividend to help finance that, but nevertheless a significant step away from its traditional business. How big a headwind is, though, the carbon story going to be for this rotation? We've seen during this crisis, government after government make it clear that one of the ways that they are going to invest is in a green revolution.
It doesn't need to be a headwind. Actually, we made a lot of research on this at JP Morgan this year in the context of a long-term capital market assumption, also in the context of several of some solution launch that we have made recently. So really this transition to a lower carbon economy obviously obliged corporate companies like Repsol to really rethink the nature of their business. But it's an opportunity, and thinking about this rotation value growth, clearly, as we see more and more policymakers moving with a tougher climate strategy entering into 2021. This is especially the case in Europe, but could be soon the case also in the US. It will benefit some sectors in Europe, some value sector as well. I'm thinking about renewables, for instance, which is really an area where Europe has some leadership in it. So clearly this carbon transition, in our view, could be a major opportunity for investors. The thing we need to do as investors is to look everywhere where we invest at the carbon intensity of our holding. Clearly, going forward, we would expect those companies which have a higher carbon intensity to manufacture goods and services same than their competitors, but with a higher carbon intensity, we'll see a lower margin, will be less profitable on financial markets. So clearly, this is a parameter which is more and more important in our investment decision today, carbon intensity. And indeed, 2021 could well be the year of a grand climate accord. We know finally have the US supporting those international efforts, supported by Europe so far, but also China. Many countries have committed to a carbon neutral by 2050. Let's hope that the US join, obviously, this movement in January, and then we would be all set for a possible more ambitious accord in Glasgow for the COP26, more ambitious than we had in Paris, for instance.
Vincent, if I've got a time frame of more than 6 months, which many investors obviously will have, why would I want to sell innovative companies, technology companies, companies that are going to change the world going forward? Why would I want to spend time trying to figure out which value companies, which the market can't really figure out how to value because it doesn't understand what some of these legacy businesses are going to do in the future? Why would I want to spend time focusing there, even if we are going to see a short-term bounce back? Why would I want to sell my technology stocks?
Our message is definitely don't sell your technology stock, keep this sector. This is one of the structural themes which we have identified, that everybody is following, that we capture at JP Morgan, which play out not only in listed equity market, but across the board in our private equity business, in our infrastructure business, in our real estate business. So clearly, the tech theme is there to stay, and we remain confident in it. This said, as investor, we need to diversify, obviously, our bet. And we believe that as we enter a new decade, obviously, a new economic cycle and possibly a new market cycle, we need to also look at what could be the next tech in financial market. And green could well be the new tech from that perspective. And that's a theme that you should try to capture along your tech theme in your portfolio.
Am I going to get the biggest bang for my buck in terms of making these investments in Asia? In many ways, China has been able to scale many of these technologies in a way that nobody else has. And I'm wondering if that is going to apply to the green revolution as it applies to the silicon revolution.
Definitely, China has been very successful at it. More than 50% of batteries, of wind turbine, of solar panel are manufactured in China. So clearly, China has understood that it needed to lead this decarbonization. China will, as of the start of 2021, have the biggest emission trading scheme in place. So really, China is doing a lot of effort in this space and needs to do it because they're by far the biggest greenhouse gas emitter. But China is clearly to be a leader in this decarbonization, in its transition to a low carbon economy, which is one additional reason to consider China and Asia for long-term investors. We've discussed that together already over the past few months. Obviously, at JP Morgan, we like Asia, we like China. We have made several recommendations to be long this market, obviously for its intrinsic characteristic, but also the ability to be exposed to this tech theme, but also to this new green energy theme, which is more and more present within China.
Always a pleasure. Nice to see you. Thank you very much indeed for your time. Also, Juvens of JP Morgan Asset Management. European stocks have now finished. Very quiet session, delivered with very little volume as a result of the Thanksgiving holiday in the United States. But these are the final numbers. As you can see, a little bit of underperformance coming through from the London markets. A little tick higher during the auction process, but not really that much to talk about. The biggest losers coming through from Persimmons. We've seen Imperials coming down in terms of points. It was National Grid, BP, and CRH plus Astra that actually did the damage on the downside for the FTSE 100. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Hi from London, I'm Guy Johnson. This is the European Close on Bloomberg Markets. So the UK faces its worst economic slump since 1709. That's the worst in 300 years. 1709, significant. That was the year of the Great Frost. Well, that was certainly the headline from Chancellor Rishi Sunak's spending review delivered yesterday. He expects the economy to contract to more than 11% this year and unemployment to reach 7.5%. Those figures are calculated by the OBR, the Office for Budget Responsibility. Budget Responsibility Committee member, Sir Charlie Bean, joins us now to discuss the numbers. So, Charlie, thanks for your time. Look, the Chancellor announced a great deal of spending yesterday. It was a spending review, and he announced certainly a great deal of it. Do you think, though, that we may end up actually, given the trajectory we're on at the moment, having to spend even more than the Chancellor confirmed yesterday?
Well, of course, what he talked about yesterday includes the spending that's projected over the rest of this financial year. So it includes the extension of the furlough scheme, it includes provision for the rollout of vaccines and so forth. And given we've had good news on the vaccine front, I think it is reasonable to think that we might be on the home straight here and that the economy will be recovering next year. So one would certainly expect the public finances to be improving as we go through next year. We're expecting for this financial year a deficit of a little bit under 20% of GDP, 400 billion. But it should come down pretty smartly as the furlough scheme ends, as COVID-related health spending comes to an end, and so forth. The key unknown, though, is whether we regain the pre-virus trajectory that the economy was on, or whether we come back to a level somewhat below that. And in our central forecast, I stress there's a lot of uncertainty, and that's why we provided three scenarios, an optimistic, a central, and a rather more pessimistic one. But in our central view, we have a 3% hit to the level of activity, which persists as a result of the pandemic, the hit to investment, possible restructuring in the economy, and so forth. And in that case, there would be a deficit that would need to be dealt with in the medium term. Our report discusses the sort of adjustment that might be required, and you'd be talking about 20 to 30 billion if that forecast were to come to pass.
Okay. Just sticking with that central forecast, can I ask you the timeline you went through putting this together? Clearly over the last few days, actually the last 3 weeks, really since the 9th, there's been a lot of very good vaccine news, and I'm wondering how much of that is factored in to that central forecast.
Okay, our forecasts take quite a long time to compile because the primary reason that we do them is to produce forecasts of the public finances. And there's a lot of interaction with government departments and so forth. The news about the Pfizer and Moderna vaccines came through towards the tail end of when we were finalizing numbers. And we'd essentially finalized the text, and it was all ready to go to the printers when the good news about the Oxford AstraZeneca vaccine came through. So in that sense, they're not formally in the figures. But one thing I would stress is that although the news on the vaccine front is undoubtedly good news, there's still quite a way to go yet. So first of all, we have to get through the winter without hopefully a resurgence in cases after lockdown ends. Then there's the whole logistics of rolling out vaccines, which is certainly more demanding for the Pfizer vaccine and the Moderna vaccine. The good news for the Oxford AstraZeneca vaccine is that that's less demanding on a logistical, from a logistical perspective, because it doesn't have to be kept at such cold temperatures. But there's always the possibility that as they're rolled out more widely, we may discover there's problems with them, they're less effective. We don't know how effective any of them are at preventing asymptomatic transmission. And there is always the possibility that the virus itself mutates. And we only have to look at the mutation in mink farms in Denmark to realize that's a risk. And that may render the vaccines less effective or ineffective. So our downside scenario is certainly a possibility, but certainly I think the balance of risks has shifted in a favourable direction as a result of the news over the past week or two in respect of vaccines.
The OBR and the Institute of Fiscal Studies and a lot of other people have been trying to figure out ultimately how the deficit gets filled. The government clearly doesn't want to deliver austerity again, and certainly has resisted that as a possibility, though there is looking like there's going to be a public sector wage freeze. My question is, though, regarding taxation. Is it simply too early at this stage, Sir Charlie, to be talking, even hinting, about the possibility of raising taxes, in as much as that will have a behavioural impact, and that potentially could have a negative effect on the way people spend and invest? And I'm wondering, therefore, is it simply too early to even thinking about raising taxes at this stage?
Well, it's certainly a mistake to be doing it. There is no need to start any consolidation process until the emergency is behind us, the pandemic is behind us. However, what is important is that the government maintains its commitment to sustainable public finances in the longer run. And of course, the Chancellor in his speech said he was still committed to that, and he's committed to bringing forward some new fiscal rules that embody that in the coming months, probably at the next budget. Now, I have heard this argument that you shouldn't even talk about what you might do to close any deficit going forward, any unsustainable deficit going forward. Of course, if you don't do that, if you don't start at least making some general indications, there is a risk people expect you to do things which you won't be doing. Yeah, so I'm not sure I entirely buy the argument we shouldn't even talk about it. I think it makes sense for the Treasury to be thinking about the options, what are realistic. A lot depends on how much longer-term scarring there is in terms of how much consolidation you need to do. If we regain the pre-virus trajectory, the answer is probably not very much. It's only if there's quite a lot of long-term adverse effects from the pandemic on the economy, and we're on a permanently lower trajectory, then you would need a bigger adjustment. But it does seem to me sensible for...
have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Your input, greatly appreciated. Sir Charlie Bean, Budget Responsibility Committee member at the OBR. Within the last couple of minutes, RTE, the Irish news agency, suggesting that Michel Barnier, the chief Brexit negotiator for the EU, has called, quote, an urgent meeting of EU fisheries ministers for tomorrow, one of the key areas that we're looking for progress on in the Brexit negotiations. I hope you've enjoyed the show. Happy Thanksgiving if you're watching in the United States. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
we explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is a difficulty, a challenge, which needs government response.
The Fed is really pleading for fiscal relief. I believe it's essential.
The American administration is about to change, but the clock will not simply be rewound.
How fast could we go to underserved communities and pull people into the middle class for the first time?
There's a period of, I think, great uncertainty and great risk.
Our city need to be ready for the convergence of the physical and digital worlds.
We need to use our recovery stimulus to invest in the clean and digital technologies of the future.
The question is, what direction are we pointing our economies? We're going to point towards sustainable growth.
It's the most important mindset to break, is that there's a trade-off between a green recovery and an economic prosperity.
Hello and welcome. I'm Carol Masser. We're looking back at the 2020 Bloomberg New Economy Forum. Now in its third year, this annual summit brings together leaders in business, politics, and policy from around the world to discuss the most pressing issues facing the global economy. Now, due to one of those issues, the COVID-19 pandemic, the 2020 event was held as a virtual town hall, and it focused on the challenges of rebuilding a new economy in the wake of the virus crisis, one that's inclusive and sustainable for all. To lead us through the program, here's my Bloomberg colleague and forum co-host, Scarlett Fu.
Thanks, Carol. The coronavirus pandemic is the single biggest threat to the health of the global economy, and many believe it's exposed a deep sickness in society, inequality. Central banks have devised policies to keep capital markets liquid and prop up asset prices. But can these institutions use their tools to build a more equal society? Former Federal Reserve Chair Janet Yellen and former Bank of England Governor Mervyn King discussed the challenge.
Monetary policy has its limits, and the effective lower bound is a serious constraint. And the notion that the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential. I think the Fed has been less successful in lending to smaller businesses. That creates an impression of unfairness that the Fed is on the side of big companies and on Wall Street. This is something that's very difficult to accomplish. But, as Chair Powell says, the Fed can't spend, it can't give grants, it can't direct aid to where it's needed to unemployed workers, and fiscal policy has a very important role to play now as well.
Lord King, I know you've echoed some of what Janet Yellen has said in repeatedly saying central banks can't do everything. Do you think they've played the expectations game well in responding to the crisis, or have they set them too high?
So I share much of what Janet has said, but I think to explain what's gone wrong, I don't think central banks have explained clearly why expanding the money supply is the right sort of response to a shutdown of the economy created by governments, different levels of governments, in order to prevent the spread of COVID-19. This isn't a conventional recession. And as Janet said, the most important thing for central banks to do now is to say that this is a difficulty, a challenge, which needs government response, not central bank response. And I don't think it's government response in the sense of general fiscal easing. I think it's a response that's required to support businesses until we get through this COVID-19 episode, at which point we can then let the market economy decide which businesses will thrive and which will fail, which I don't think we can do at present.
Private companies will also play a critical role in shaping a more equitable economy. IBM Executive Chair Ginny Rometty sized up the task ahead.
This is something we got involved in about a decade ago, and it was for the reason that you could begin to see the digital economy would not be inclusive. There would be far too many have-nots versus haves, and this would revolve around having the right skill to work in a new job and have it quick enough. And so, as you see with COVID, and then with all the issues around racism and systemic racism that have evolved, this has just escalated this issue that was, as the minister said, on a slow burn. So what we set out and coined a term new collar, so it would have a positive connotation. We said we had to offer a new pathway for people into our company, not just a traditional four-year degree. And so new collar was meant to be, you could start, it wasn't white collar, it wasn't blue collar, and those connotations with it. It would be about a new collar job so that you could start without a four-year degree. And there are many new jobs that live at this intersection with technology, cloud computing, cyber skills, that you could get started. And what you'd have to believe as an employer is in three different paradigms. And I think in some ways, Jason, this would be my definition of a new social contract. One would be, I would have to hire based on skills first versus degrees only. Meaning I'd hire you because you had some skills that you had built in some way. The second paradigm is I'd have to offer a new pathway. The minister used that word as well. So in other words, perhaps you've come from a 6-year high school, which is what hopefully we'll talk about. We got very involved around the world in this. And then the third paradigm would be as an employer, I offer you employability. While I may not guarantee you employment, I can offer you employability, meaning the ability to constantly build the skills that you can have a very good job. Because the issue here is going to become quality jobs, not just any type of job. So that led us down a path of what is a public-private partnership with high schools and community colleges around the world to build and say, how fast could we go to underserved communities and pull people into the middle class for the first time? And we now have a pipeline of almost 200,000 students coming through.
COVID-19 has forced nations to physically isolate. It's also exacerbated geopolitical rivalries. U.S.-China relations are as strained as they've been in decades, even as the two sides signed a Phase 1 trade deal at the start of the year. With a new U.S. president set to take charge in January, prominent voices in business and politics shared their views on the path forward for the superpowers.
The American administration is about to change, but the clock will not simply be rewound.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
I don't think there's a big bang win here for either side.
Coming up, we continue our review of the Bloomberg New Economy Forum. Ray Dalio says investing will look very different in a post-crisis world.
There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it.
And ECB President Christine Lagarde warns policymakers about financial spillover.
We need to really stay clear of that because that would be an aggravating factor.
This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Welcome back to our review of the 2020 Bloomberg New Economy Forum. I'm Carol Masser. The global economy will undoubtedly be different when the world emerges from the COVID-19 pandemic. How it changes will largely depend on how leaders in government, business, and finance work together to rebuild it. Those leaders had plenty to say at the forum. Scarlett Fu has more from our program.
Thanks, Carol. Even before the coronavirus pandemic struck, regime change was underway in the world of investing and finance. Now it's happening even faster. Ray Dalio has been preparing to navigate these choppy waters for a long time. He explained how his firm, Bridgewater, is adapting its portfolio strategy.
There's a period of, I think, great uncertainty and great risk. And so I think there are three words: diversification, liquidity, and then differentiation. We want to make sure that our investors are not just concentrated in some of the traditional markets. So diversification of how to do that well can reduce risk without reducing opportunity. And that means currency diversification, including the reserve currencies, how much exposure is to the reserve currencies, but it means currency diversification, asset class diversification, country diversification, and that should be the starting point of portfolios. In terms of liquidity, it allows you the flexibility to change as circumstances change. And differentiation is the most important consideration now. There are two different worlds. There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it. And that differentiation versus other worlds and markets related to that, that will be bankrupt and disorderly. That kind of differentiation is important.
As president of the European Central Bank, Christine Lagarde will play a critical role in the EU's recovery post-crisis. She discussed the potential for a COVID-19 vaccine by early next year and a key challenge facing policymakers.
I think that the second wave that we saw presents risks. The first risk that I would think of is the fact that consumers, investors, employers do not regard the pandemic as a one-off, this V-shape that we all aspired to, but as something that will recur over the course of time, and as a result would lead them to completely change their behavior. In other words, how about if they start saving again for precautionary purposes? How about if they continue to freeze and hold their investment plans because of the uncertainty generated by this situation? And the second risk that I see is the potential real/financial spillover, which we have managed to avoid so far. So in other words, we have not had the financial sector amplifying the downside that has weighed on the real economy, and we need to really stay clear of that because that would be an aggravating factor.
A portion of the New Economy Forum was devoted to the challenges facing cities. Urban economies have been hit hard during the pandemic, but civic leaders are responding with creativity and tenacity, reinventing the modern metropolis. India's Prime Minister Narendra Modi shared his views on the future of cities.
We are looking at a future where a major chunk of education, healthcare, shopping, food experiences may happen online. Our cities need to be ready for the convergence of the physical and digital worlds.
Of course, cities have had to confront public health threats for centuries. Here's a look at how lessons learned from previous pandemics may help with the global recovery from COVID-19.
Humanity has faced the challenge of deadly disease for thousands of years. And whenever a new pandemic takes hold, civilizations adapt in response. In the 19th century, cholera epidemics in Europe set off an outcry for investment in modern sanitation and urban renewal. The movement sparked Baron Haussmann's transformation of Paris into the City of Light, trading crowded slums for wide tree-lined boulevards and monuments lit by gas lamps. Haussmann's modernization prompted cities all over the world to follow suit. London added sewage systems, and New York built Central Park, adding a reservoir and green space for city dwellers to take in fresh air. At the turn of the 20th century, tuberculosis swept through the US, creating a greater need for urban parks and bringing light and air into building designs. The 1918 flu pandemic led to the invention of the radiator, with steam heating systems designed to allow windows to be left open, even during winter months, for improved ventilation. COVID-19 has already intensified a push by cities around the world to reduce pollution by adding bike lanes, pedestrian walkways, and implementing building design changes. Paris is pioneering the idea of a 15-minute city, creating walkable communities of shops, schools, and clinics, reducing the necessity of cars or public transport. In the distant past, it took decades for pandemics to leave their mark on our city's urban design and architectural landscape. Well, the changes sparked by this COVID-19 are already taking shape.
Coming up, more from the Bloomberg New Economy Forum. BlackRock's Larry Fink sees momentum building to combat the climate crisis.
We were beginning to see the tsunami of change already from the private sector.
And with vaccines on the horizon, Bill Gates discusses how COVID can be conquered. This is Bloomberg.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to our review of the 2020 Bloomberg New Economy Forum. I'm Carol Masser. Climate change poses risks to the global economy that could ultimately cause deeper and more permanent damage than COVID-19. For more on the discussion of climate change and the green economy at the forum, here's Scarlett Fu.
Thanks, Carol. Leaders in business, finance, and government at the New Economy Forum made the case for a green recovery to repair the economic damage from the pandemic, and they expressed optimism that it can be done.
This is about capitalizing on existing market forces, not fighting them. We need to use our recovery stimulus to invest in the clean and digital technologies of the future, to make our economies more resilient and our societies and job markets fairer.
This is an opportunity to both address the problems that will come out of this crisis, to restart growth, to put the global economy not just on a higher growth trajectory, but also on a much more sustainable growth trajectory. So going forward, and we do hear countries announcing plans to step up action on the climate front. And so I am hopeful that much more will be done. But 2021 is the year when this should happen.
It is Unilever's profound belief that purpose and sustainability are a pathway to better financial performance. There is no trade-off. And we're already seeing that money that gets invested in green stimulus seems to generate a better ROI than the more broad stimulus packages. So it's the most important mindset to break, is that there's a trade-off between a green recovery and an economic prosperity.
In 2020, we saw at BlackRock more than a doubling of investments towards climate change. And the inquiry we're having from U.S. companies, U.S. foundations, globally, we're seeing a change. So we were beginning to see the tsunami of change already from the private sector. And now with the potential of having a Biden administration, I think we're going to need the government to come along and help us on this journey.
Former Bank of England Governor Mark Carney has shifted his focus from monetary policy to climate policy. He's working with the UK government and the United Nations on climate action and finance. Carney told Bloomberg's Alex Steele there's no time to waste in this effort.
We need to invest now. I mean, we're touch wood, we're going to be coming out of the health and economic crisis. The question is, what direction are we pointing our economies? We're going to point towards sustainable growth. Huge investment. You rightly started with that, Alex. Huge numbers for investment that's capital intensive. It's job heavy. Having that information now so companies and investors can put money to work is critical.
So what role then does policy play in that? We just had an election, obviously, here in the U.S. What's the role of public policy?
Yeah, so I think there's a couple roles. One, and I wouldn't understate this first bit, is set the direction. So one of the planks of President-elect Biden's platform was the U.S. is going to move to 100% clean energy and net zero by 2050. So you set the direction. Secondly, you put in place the frameworks that are necessary, that information for investors to make the decision, and you also have credible regulatory policy. So you're showing the direction of the economy. More hydrogen, zero emission vehicles, moving towards electrifying more of the economy and moving the electricity sector and generation towards renewables. All of those things send signals to investors, provide the information as well, and gets money moving. So that's what government has to start with, the objective, fill in with the framing, and then candidly get out of the way so the private sector figures out where to go.
Investors around the world are demanding green investments. But what exactly does green mean? Guggenheim's Scott Minerd addressed this issue from an investor's perspective.
Very little time is being spent on trying to set economic incentives. Until the private sector has economic incentives to get there, the reality is that everybody will continue to act in what they think is their best interest. And right now, a great organization like HSBC, who's made a huge commitment and is way ahead of the curve, can be negatively impacted if they move too aggressively when other people decide they're going to take advantage of the fact that HSBC has changed their policies.
So do you think that this is something that needs harmonization, like in a way that we bring more groups together to sort of set targets? Is this a policymaker's question? Like, what's the Who's going to be the prime mover on making this come together in a way that's beneficial for everyone?
Well, I think it's all of the above. I think the policymakers need to look at this and understand that there are incentives that can be put in place which basically don't cost anything for the governments. But two, I think the investment community in the broad sense should be getting together and discussing this issue to try to be develop a uniform standard about a baseline for what the objectives are, what the definitions are, and what the rules of the road are.
The Bloomberg New Economy Forum also featured sessions on infectious disease research, public health, and the progress of COVID-19 vaccines and treatments. A conversation with Bill Gates touched on several of these critical issues, including the prospects for eliminating, not just controlling, the coronavirus.
We don't know enough yet to say, can we do the elimination of this? That would be the best, because then zero's magical, because it just doesn't spread at all. It doesn't come back. I think there's a good chance we can do that, but we'll have to look at the vaccines, how good they are at blocking transmission. Because this is a super spreader disease, it is likely we can do that. Otherwise, we'll have to maintain immunity on an indefinite basis, which probably means booster shots. And a little bit, as people come into the country, do they have a digital certificate that says whether they've been vaccinated or not, which that's fairly complex and will need for a period of time, like we've tried to do with yellow fever. But as the U.S. rejoins the WHO, this idea of what does the vaccine certificate look like, hopefully that dialogue will begin.
Visit Bloomberg.com to see much more from the 2020 New Economy Forum. Bloomberg subscribers can access NEF Go on a terminal for complete coverage. I'm Scarlett Fu. Carol, back to you.
Thanks, Scarlett. And thanks to all the participants who made the Bloomberg New Economy Forum a success. As the world continues to battle the pandemic, we hope it will help inspire the practical solutions and innovative actions needed for an inclusive, sustainable economic recovery. I'm Carol Masser. Stay safe, everyone. This is Bloomberg.
A sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Yelp is the go-to site for raves, rants, and recommendations. Since its launch in 2004, chances are, if it's a business down the street from you, it's got a Yelp page. But the coronavirus pandemic dealt a devastating blow as thousands of businesses across the country were forced to shut down. Yelp laid off 1,000 of its own employees. Now, with a vaccine in sight, but virus uncertainty still ahead, Yelp serves as a sort of mirror to the health of American business. Still, it's not COVID that CEO Jeremy Stoppelman is most worried about. It's the growing shadow of Google. In this edition of Bloomberg Studio 1.0, Yelp co-founder and CEO Jeremy Stoppelman.
Take me back to March 2020. The pandemic hits and the lights go out literally at thousands of small businesses across the United States. As the person who runs the most prominent platform for small businesses in the country, what was that moment like for you?
Probably the best word is terror. It was a scary moment, I think, obviously for America, for small businesses, and especially for Yelp, because we're a way to find great local businesses. And, the first thing crossing my mind is, are people going to still buy advertising? Like, are all businesses going to be affected or just a portion? We had gone through, I was CEO in 2008 when we had that major recession. And so I knew that Yelp as a company should be resilient, but I had never faced anything remotely like a pandemic where every business is potentially affected by shutdown. So it was a very scary moment for me and for the company.
Did reviews come to a standstill? Did advertising stop?
We certainly took a pretty big hit in advertising dollars as people paused their campaigns. Fortunately, we had functionality that allowed them to set a future date, and so we encouraged people to, set a resume date for their advertising months later, perhaps as the pandemic had passed, or at least when the panic would have subsided. Our focus at Yelp was really getting employees ready to work from home, getting people out of offices. This is all, kind of late February. It hit our radar as, hey, this is coming. We need to get, salespeople at home. All of our salespeople have desktop computers in an office. Like, how do we get them equipped to try and work out of their home and keep the company running? And so there was a lot of operational challenges transitioning people to work from home and getting ready to try and adapt to this extreme crisis.
So fast forward to fall, Yelp shares spike 20% on news of the early success of the Pfizer vaccine. And if everything works out, that could mean the economy opens faster. That's good for small businesses. That's good for Yelp. How optimistic are you?
None of us have been through a pandemic before, so we can't know everything. But, I can't say that in the last quarter, things really had come back. Economic activity had picked up. We were seeing people starting to dine at restaurants. Obviously, with the better weather, we weren't quite into winter yet. People were returning to restaurants. Home and local services, as people spent more time at home, really has held up throughout the pandemic. We've really come back in a big way, faster than even we were hoping for. And with the vaccine potentially arriving and starting to get out there, I think we can finally say, hey, there is light at the end of this tunnel. That's been the scariest thing about the whole crisis is we had hoped that a vaccine would arrive, but actually knowing that one is there and that it's actually 90% effective, I think is very exciting. Certainly for us at Yelp, hopefully for lots of in the minds of small business owners, and the rest of the world is very happy, I think, to hear that news.
So what are you expecting to see over the holidays, given that we're going into winter, cold and flu season, a potential spike in COVID cases? We're already seeing hospitalization surge, and we know that people aren't going to be traveling and out there shopping and eating out like they normally would.
I mean, it's hard. I'm not currently contemplating national shutdowns where everyone is frozen in place like they were, kind of the March, April timeframe. I think people will have to be cautious, in restaurant dining will probably be curtailed or very limited depending on the situation in that particular region. But I think again for Yelp's business, a lot of it is buoyed by the home and local sector, which has done really well. As people are home, things happen. Your roof leaks, you got to get that fixed. Your toilet clogs, well, your whole family is, your kids are possibly doing their remote schooling there. You got to get that thing fixed. And so those service providers will continue to do well and will continue to spend to acquire leads from sites like Yelp.
Now, you regularly release these economic impact reports, and from what I can tell, by the end of summer, you found that 160,000 businesses had closed on Yelp. Where does that number stand now? What are businesses telling you about how they're doing, region to region?
We have seen, lots of businesses reopen that were temporarily closed. I think the number is around 220,000 of the temporarily closed businesses have opened back up again, which is a great sign. And also from a new business standpoint, especially in the restaurant and food sector, we're seeing new business openings at levels that are in line with 2019. So, that's one really inspiring thing, showing kind of the resilience of American entrepreneurship, is that businesses are, new entrepreneurs are still being born in this environment, which is incredible. I think it just shows incredible tenacity and bodes well for the economy as we start thinking about 2021 and beyond.
Now, early on in the pandemic, Yelp laid off 1,000 people. You furloughed a bit more than that. Where does staffing stand now?
At the start of the pandemic, obviously, we saw advertising revenue dropping very rapidly. We had to make some very tough calls around our people, people that were incredible employees for us, and it was a very difficult moment. We had to lay off 1,000 people, as you mentioned. We also furloughed about 1,000 people as well. And that set us that put us into a stable position to ride out sort of the immediate impact of the pandemic and whatever economic damage would result. And 4 months later, we were actually in a position to be able to bring back extend offers back to almost all of the furloughed employees. And so that was a great feeling. Obviously, it's very tough, to let anybody go. But we had made a commitment to these furloughed employees, and so it was great to see so many of them back working at Yelp, and many of which are here today.
Now, the pandemic, as you alluded to, has become very, very political, and I'm wondering what your take is on Joe Biden's election. Are you at all concerned that his safety-first approach could, mean the economy opens more slowly?
I think we have to be guided by science. We have to take a dispassionate look. We have to take politics out of it and say, we can't really have a great economy if everyone's cowering, from impacts of the pandemic or hospitals are getting overloaded with cases. So we just have to take a sensible approach. We have to listen to the scientists. If they're telling us that, wearing masks is going to, diminish the impact of the pandemic, then we should all be wearing masks. It's very straightforward. It shouldn't be a political issue. It's very frustrating that it has been. And I think that costs us valuable time and, even more importantly, costs us health and even lives.
It seems like the next stimulus package might be more scaled back. Are you concerned about a divided government, meaning that small businesses aren't going to get the help they need?
I think the Fed chair has been pretty clear that, businesses need support, especially small businesses need support. And I think the initial stimulus package was a positive. And, we've been all waiting and hoping for another one. And I think, we shouldn't just have socialism for big companies where they can borrow endlessly with cheap debt from the, powered by the Fed. We should extend the helping hand to all these great small business owners that are just trying to get by. An assistant of mine, broke into a meeting and tapped me on the shoulder and literally slipped me a Post-it note that said Steve Jobs is on the line.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
We could spend a lot of time talking about old stories. You've been in Silicon Valley a long time. You were part of the early PayPal team. But there's one old story that I really do want to ask you about, which is that Google tried to buy Yelp back in 2009 for over $500 million, and you turned them down. Explain how that played out.
Well, I think that Yelp was doing something really positive, which was, growing quickly, gathering all this useful information about local businesses that, frankly, no other site had. And I think Google saw that Maps was of growing importance to them and was interested in Yelp. And we initially had a partnership. But ultimately, I think, Google wasn't satisfied with that partnership and wanted to get into the business themselves. And so then, there was a back and forth where they had some interest in Yelp. But ultimately, it didn't work out. I think we saw things differently. And I think that was good. It allowed Yelp to stay independent and to grow on its own. And frankly, I think I've been able to develop as a CEO quite a bit as well. So I think it's been good for me personally.
Now, as the story goes, Steve Jobs, who was obviously running Apple at the time, Google's biggest competitor, called you to convince you to turn it down. Did that really happen?
It did. Yeah, it was a bit of a surreal moment. I'd call it probably a career highlight, still a peak highlight for me. When an assistant of mine, broke into a meeting and tapped me on the shoulder and literally slipped me a Post-it note that said Steve Jobs is on the line. And so I ran out of the meeting and then, picked up the phone. And of course, it wasn't Steve Jobs. It was Steve Jobs' assistant was on the line. And so then I was waiting for Steve Jobs, who did ultimately get on the phone. And he had some not so nice things to say about Google and some nice things to say about Yelp, and said, he loved Yelp and that we should keep going. And if it was a money thing, then we should be talking to Apple, not Google, but we should just keep doing what we're doing. And, I thought that was good advice.
So fast forward to today, Yelp is now a $2 billion public company, but also Google is now your biggest competitor. Did you make the right call?
Well, I think I did. I think Yelp continues to serve on its mission, which is connecting people with great local businesses. And it's been a really rewarding journey. And I think lots of people find Yelp still incredibly valuable. I think, over 100 million people come to Yelp every single month and steer themselves to a great local business. So I think it's going well.
So the Department of Justice has recently sued Google over antitrust. Taking on Google, competing against Google is no joke for any business. What was your reaction to the suit?
We've been working on this topic for a very long time, so there was a good feeling, I would say, in the Yelp office, because we've been kind of shouting from the rooftops for a very long time that there is a monopoly problem in this country, and in particular there is a Google problem in this country, and Google has behaved illegally and has leveraged its monopoly in ways that are destructive to innovation and competition, and bad. It's bad for consumers, bad for small business owners. And so it was great to see some early validation of that from the DOJ.
Now, we've all seen the increasing number of Google reviews, and, Yelp's main complaint that Google favors its own reviews over yours isn't actually the core of the case. Are you at all concerned that your concerns might get passed over?
I mean, it's hard to say where the case goes right now because the state AGs will be, sort of bringing their own cases, and presumably it gets consolidated. So it's hard to know the exact scope of the case. I think, the early signs that, from our perspective, are positive. And, again, there's bipartisan support for really scrutinizing Google and taking a look at their behavior over the last decade. You look at like television over the last 40, 50 years, it was a highly regulated industry. You look at radio, highly regulated. Even going back to movies, there were antitrust cases that made a big difference in the distribution of films. And so why is it that technology should be completely immune to that, especially these new, sort of the Google generation of technology companies? Why shouldn't, Congress exercise its power? Why shouldn't the DOJ investigate? Why shouldn't the FTC investigate?
You told 60 Minutes back in 2018, if I were starting out today, I would have no shot of building Yelp. That opportunity has been closed off by Google and their approach. If you provide great content in one of these categories that's lucrative to Google and seen as potentially threatening, they will snuff you out. They will make you disappear. They will bury you. Has Google continued to try to bury Yelp since that time?
I mean, it's an easy thing to test for yourself. You could just, do essentially any search with local intent and then see how far down the page you have to go to get to any kind of organic result, especially in, a category that's particularly lucrative from a SMB advertising standpoint. I mean, they've really tried to maximize the revenue, and in doing so have put the consumer in the back seat. And I think that's a real problem. But then also it stifles innovation, because if it's basically there's no organic content anymore, there isn't really that incentive for creators to try and create new and interesting websites, collect information from users. I think it's quite sad. And I think if you talk to the venture capital community, you'll hear that as well. There just isn't as much interest in ideas that are powered by search engine optimization, where you create really wonderful content and then Google or other search engines drive you traffic. Like, it's just Google now, and if it's a lucrative vertical, they're going to try and suck up all of the revenue.
Now, President-elect Biden hasn't detailed his thoughts on antitrust yet, but we know that the Obama administration was fairly close to Silicon Valley, and Google in particular. How would you like Biden to weigh in on antitrust? What do you want lawmakers to do? Should Google be broken up?
Yeah, I think all we can ask for is independent thought. And so you're absolutely right that unfortunately the Obama administration has a very bad record when it comes to antitrust enforcement and especially Google scrutiny. I think Google's lobbyist was the #1 lobbyist in the White House by visits. And so that's been widely reported. And even as the FTC was purportedly investigating, there was seemingly, back-channel communication with Google, which, is very sad to learn of. And so I would hope, and I think there's some indication that Biden is going to take a more independent view of this. And I think we'll have to see, who's involved in the administration, who's in the cabinet, who are the people around Biden. My personal thought is somehow we have to get Elizabeth Warren in there, because she's been particularly strong on, hammering home the point that monopolies are not good for the economy. They're not good for innovation. They're not good for consumers. And so we need someone like that with a really strong message and a strong independence streak as well.
Now, all of that said, some businesses have complained that Yelp reviews skew more negative. How do you respond to, this complaint from businesses who, might prefer Google because they see that they have more positive reviews there?
We try to be, the most independent, create a level playing field for businesses. And, that frustrates businesses that, frankly, on other platforms are used to getting what they want, which is, being able to ask their friends to write reviews for them, being 5 stars. And in fact, the data supports that. So the FTC, an economist there, recently put out a paper that talked about the review distribution on the various platforms. And Yelp actually has the most balanced review system, which is very validating. That feels great to me, because that's what we're trying to achieve, is just a mirror of the real world.
If you are a woman or a person of color in Silicon Valley these days, what's your advice?
These are talented people. They do have a lot of options, so make sure you choose an option that supports you and makes you feel valued.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
You're an engineer, you worked at X.com, back in the day, the online bank that was started by Elon Musk, which merged with PayPal. What are some of the biggest lessons you've taken from that time in your life and those people who I imagine are still in your life today?
One of the big takeaways from PayPal was just how much you could do even if you had no experience. And so I joined X.com, which eventually merged with PayPal when I was 22, I think. And very quickly, I became an engineering manager, maybe a year and a half later, 2 years later, and then ultimately rose into the executive ranks there on the engineering side. And thinking about it, it was kind of preposterous that those folks would give me so much responsibility so early in my career. But the fact that we somehow pulled it off and created a successful consumer brand and payment site that ended up being really critical to eBay, and then ultimately now as a payment service that so many of us use, I think validates that it's not all about experience. A lot of it is grit, determination, creativity, innovation, all of those good things. And so I've tried to bring that with me to Yelp, frankly. We try to make sure that people have fantastic careers. We have a lot of growth from within when it comes to promotions. And we have a lot of homegrown, now senior employees. And so it's really validating to see people step up and take on more responsibility over time.
Where do you fall on the importance of culture? Because it seems like there's a group of CEOs in Silicon Valley who seem to think it's important and others who seem to think it's all about growth. Well,
I think you want both. I think it's hard to be a company and not have robust growth. It just fundamentally is difficult, especially in the technology industry where things change so fast. So if you're not growing, then you're probably not keeping up, and then eventually you fall over. But I think we also see that culture is important, especially in recruiting the top talent that you need to succeed here in Silicon Valley. Is you need to have a great culture. You need to be on top of things, what's going on in your organization. Because if you don't, somebody else will be good at that, and then people will flock to that company that is also high growth. There's always other shiny new objects out there. It's you want to deliver, I think, on both dimensions as a CEO.
There's been some reporting in Business Insider that Yelp has an aggressive sales culture. What's been your response to that?
I mean, we're one of the most highly scrutinized sales teams, I think, in the history of local sales teams. I mean, for many, many years, business owners, for instance, would accuse us of extortion because they claimed that you could take down Yelp reviews if you paid us. That was never true. And so any individual anecdotal accusation, I think you have to take with a grain of salt. We do have thousands of salespeople, and so is every conversation going to be perfect? Absolutely not. But, we have systems in place to ensure that the conversations are the ones that we expect, are empathetic, are thoughtful, and the vast, vast majority of those conversations are great.
Now, I've interviewed many folks in the PayPal mafia over the years, and they all seem to agree that, very smart, but also very lucky to have each other. If you are a woman or a person of color in Silicon Valley these days. You know, what's your advice? How do you break through if you don't have that kind of a network?
I mean, I think Silicon Valley has gotten better on this dimension. I think there's a growing awareness of the need to create opportunities for people of color, for women. And so I would make sure that you're aligned with a company that does care about these things. I think Yelp is a company that does care about these things, that cares a great deal about diversity. And a lot of these companies are now publishing, annually their numbers on how are things improving. Are they making progress? Do they have something to show? And I think Yelp has consistently made progress on that dimension, and it's all public. It's published annually in our reports. And so that's probably my best advice is these are talented people. They do have a lot of options, so make sure you choose an option that supports you and makes you feel valued. Because there's so many great companies in Silicon Valley. Like, don't waste your time on someone that doesn't value you.
When you look ahead, let's say 5 years from now, and the pandemic is hopefully in the rearview mirror, what is going to be the biggest source of growth?
Well, I think we have a lot of opportunity to better monetize Yelp. We talked about how only about 20% of our leads are monetized right now, and so we'd love to see that percentage drift up because there's just so much incredible value flowing through Yelp, accruing to business owners, and we want to give a boost to the people that are paying us. We want to help our advertisers get more leads, and so that's a big focus for the company. And also, we just want to build out our presence in home and local in some of these areas that people may not be as aware of. Like, I think across the country, everyone knows Yelp as a restaurant site, but how do we shift that perception and really, drive home the message that Yelp is for anything that you need locally, any service provider, any local business, you should be turning to Yelp because it has, as we talked about, the most balanced rating system, the most useful and trustworthy information. And so skip that whole Google box and just come to the Yelp app.
That's a great place to end it. Jeremy Stoppelman, thank you so much for joining us today on Studio 1.0. It's been great to have you.
Thanks for having me.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, Salesforce considers buying Slack, a deal that could be announced as soon as next week. Slack shares surge on the news. We have the latest. Plus, COVID company, cloud company, come on, Taylor, VMware, it beats estimates. We'll talk strategy both now and in a post-pandemic world, and we do it with VMware CEO Pat Gelsinger. And as millions of Americans continue to stay home amid the coronavirus, we run down some of the hottest holiday tech products out there, all as people swarmed online sites for gifts. And speaking of staying home, what streaming companies are doing to keep you tuned in? And we'll get to all of those stories in a moment. First, let's get a check on U.S. markets, where we've been really talking about the rotation out of tech shares on promising vaccine news on Tuesday. All of that reverse course Wednesday amid new data showing a possible slowdown in economic growth. Bloomberg's Ed Ludlow joins me now with more. Ed, what are you seeing?
Yeah, I'm calling it the unwinding of the rotation trade, Taylor. Clearly a move in cyclicals away from value. The S&P 500 coming off its record highs, the Dow coming off 30,000 points that we saw yesterday. And then those gains are coming back for technology stocks. You can see there the NASDAQ 100 index up 0.6%. As you said, data-wise, this was the first back-to-back rise in weekly U.S. jobless claims we've had since July. So investors reassessing what's going on with the economic recovery as it relates to COVID-19. You know, the story, as you say, has been a move into value, a move into small cap stocks, those kinds of companies that would recover if there was a successful rollout of the vaccine. But, you know, that kind of sentiment is a little bit on pause right now. In terms of the names that are doing well, it's really the stay-at-home stocks that we're talking about, the likes of Apple, the likes of Microsoft, all up on the day, including Amazon and Zoom, which we talk about so much, one of the big beneficiaries of the pandemic. But we did get this big data deluge, as well as Fed minutes that didn't really move the needle. We saw some softness in gold, some Bitcoin softness as well. We might have expected to get to that magic number of 19,511, a record for Bitcoin, but we didn't. The cryptocurrency fell away in the later hours of trading, and then also the Treasury yield on the US 10-year largely unchanged, Taylor.
I'm going to try to lure you from Bitcoin on over into Tesla, because the rally continues despite some of the stalling that we've been talking about within the rest of the EV space.
Yeah, it is relentless, and Tesla continues to lead the way up on the day. There is a little bit of a reassessment for some of those newer stocks, some of them the newer names to have listed recently. Perhaps they're pre-revenue, perhaps investors are thinking this rally's been very hot, but it's time to look off. Perhaps a suggestion as well of profit taking ahead of Thanksgiving. Some traders certainly telling us here at Bloomberg that those stocks that go up must also come down at some point, and that factors into it. But as I said, the undercurrent that is pushing EV stocks is one of policy. We're inching ever closer to a Joe Biden presidency. He has a very clear policy of reinstating a full tax credit, and the optimism, the hope, is that that will push consumers to take EV adoption more seriously, because it will put those vehicles on a more affordable footing against their combustion engine equivalents.
And Ed, I mean, it's incredible. You think the Wednesday before Thanksgiving, everyone's gone home at noon, but no, I mean, the corporate world continuing to make some big announcements. IBM, Salesforce, what are you noticing?
Yeah, relentless corporate news flow. In IBM's case, sources telling Bloomberg that job cuts planned, particularly in Europe. A little softness in the stock today, not a huge negative reaction. We had a report out that Salesforce in talks with Slack over potentially acquiring. You can see how investors responded to that. Slack up almost 38%, Salesforce down 5.3%. We're waiting to hear more. Raymond James expressing some doubt that that kind of deal could take place, but that is certainly one to watch for the coming weeks.
Thank you, as always, to Bloomberg's Ed Ludlow for the latest on all of those markets. And he mentioned Salesforce, and I do want to talk about that story next. Salesforce considering acquiring workplace chat tool Slack, all according to a person familiar with the matter. Slack shares surging as much as 34% Wednesday, while the news weighed on Salesforce, which fell as much as 5%. To discuss, we're now joined by Wedbush analyst Dan Ives. And Dan, the analysts are sort of coming out and thinking that this looks positive. What is your early take on this?
Look, the early take, it would be an aggressive move by Benioff and Salesforce. But take a step back. I mean, we're going into a golden age of cloud, and they're looking to just further expand the footprint. A Slack deal would make strategic sense And it would also be a major shot across the bow to Microsoft, Google, and others in terms of where Salesforce views the coming years, in terms of where they are positioned, in terms of what I believe is $1 trillion that could be spent in the cloud over the next decade.
Dan, some of our analysts were also noting that in order to do this, the best way is via stock, given the lofty valuations. If there were to be an M&A, do you prefer stock as the acquisition mode?
Well, I think just given the size of the deal of Slack, first off, this would be the biggest deal Salesforce has ever done, and there clearly be a significant equity component. That's why the stock sold off. But I think investors view this as forest of the trees, what this could do to Salesforce in terms of penetration on the cloud, as well as they would continue to expand Tableau and now potentially Slack. And then there's some that view it if Salesforce does not acquire Slack, do they get acquired by another vendor? So right now, this continues to be, I think, just the start of a surge of M&A across software.
Who could be that other vendor?
Well, right now, if you look, I mean, the biggest competitor, of course, is Microsoft. And you look at who would want to go up against Microsoft. And, you know, when you look at Google and Amazon and, you know, some of the traditional names, I mean, there's antitrust issues. And I think that's part of the issue when you think about who could do a deal like this. Maybe Adobe would be one, but Salesforce continues to kind of be the core front and center. And that's why if Salesforce walks away or the deal does not happen, and I think there could be just more, you know, headwinds in terms of the stock to Slack.
How nervous then should Microsoft be if indeed this deal goes through?
Well, I think for Microsoft, it's definitely a competitive threat in terms of where Teams is. Now, Teams in the scheme of things is not generating significant revenue, but I think it just shows where Salesforce is viewing itself in terms of this cloud race. It's really been a two-horse race, of course, between AWS and Microsoft, but now with Salesforce, more and more competing against Microsoft on Dynamics versus CRM, and it just speaks to this cloud pie. This is something in the work-from-home environment. It's just accelerated the cloud stories by 1 to 2 years, and Salesforce and Benioff recognize there's a time to seize on this in terms of going to fifth gear of growth, and that's what they're trying to do through M&A.
Dan, we love getting you on this program because you really can talk about most of the interesting technology companies, and we have to turn to Tesla. An incredible price target on your end at $1,000. What gets Tesla to $1,000?
It's all about China. I mean, we are at an early inflection of demand in terms of what we're seeing in the China opportunity. It's 4% penetrated today, could be going to 10% in the next 2 to 3 years. And Tesla, in terms of where they're positioned with Giga 3 and what you're seeing with adoption, and it's not just in China, but in Europe, and Ed talked about, and the Biden administration is just more and more bullish for EVs, we could be looking at 1 million units for Tesla in 2022. That's why in the EV market right now, it's Tesla's world, and everyone else is paying rent.
What about competition, though? Ford, GM, Rivian, Fisker.
Look, this is going to be a transformational opportunity for many players. When I look at GM in particular, I think that's one that has a big opportunity to be successful. You look at Fisker, and then, of course, in China with NIO and BYD and some of these others, I think that's why when you look at the overall EV market, it's not just going to be one winner in terms of Tesla. Competitively, they're going to start to narrow the gap. Right now, Musk and Fremont continue to be 18 to 24 months ahead of any other competitor. Although you look what GM's doing, I think that's probably the most interesting thing domestically in terms of competition line.
Dan, you also cover VMware. You've been outperformed a $175 price target. We're going to be speaking with the CEO next, Mr. Gelsinger. What would be the one question you would want to ask?
Look, I think Pat and the team, they're doing a great job in terms of building out the product portfolio. I think the biggest question is around cybersecurity, in terms of where that fits in the product portfolio in the cloud. They're in pole position to gain more and more share going through a SaaS transition, but I think it's looking really at that opportunity and how they can expand that with the rest of the virtualization suite.
Dan Ives of Wedbush, thank you as always for joining us on a host of topics there. And stay with us because coming up we will have more with VMware CEO Pat Gelsinger talking about the recent earnings report and why software as a service it is taking center stage. That is next. This is Bloomberg. VMware out with earnings today. Top third quarter estimates saw SaaS revenue soar 44%. However, some analysts still gave some cautious praise to the cloud company. Traders also remaining a little bit skeptical of the company's bottom line. Here to go over all the details, let's bring in VMware CEO Pat Gelsinger. Pat, always great to have you on the program. Talk to us about that outlook for the full year 2022. That seemed to be in part where analysts were perhaps maybe needing some more answers.
Yeah, and clearly as we looked into next year, we said, hey, one is we still see that the economy has a lot of choppiness yet. And, thus the first half probably a bit more conservative, more recovery in the second half. Second issue being we're leaning hard into our subscription and SaaS transformation. And with that, when you move to a subscription model, you get less upfront, but the lifetime value of the customer is better. So that's depressing near-term earnings and revenue growth rates. Those would be the two big factors. And overall, hey, we're excited. As I say, it's faster to the future. And we're taking this COVID pandemic crisis and we're saying we're going to go faster to drive that transformation because we see that's overall where the market is going. And we're going to transform our business to be a unique provider of on-premise and cloud-delivered services, a real hybrid offering that we're uniquely positioned to do.
You talk about that SaaS smile. When can we expect sort of the uptrend of that smile?
Yeah, we do see it sort of as a 3-year cycle. And as we're pressing to go into that smile more aggressively next year, the second and third years look better when you're sort of coming on the other side and the businesses that you've built this year are accelerating. The SaaS is more at scale, so the margins improve. So it really is this 3-year picture. And next year, we say against a still choppy economy, we're taking the opportunity to go faster into the smile.
With that margin outlook, how much of that, in terms of the mix of the margins, comes from investments in marketing or perhaps maybe hiring?
Well, so we've continued to invest this year. We're planning to continue to do so next year as we build our team. A SaaS model does have more also customer success requirements. right? Because you have a little order, you get them on the product, and then you have to grow it over time. So you're much more in partnership with the customer to drive their success, and that does drive up the upfront costs of a SaaS business, so we're making those investments as well. So overall, yeah, it is a bit investment heavy on the front end, but the lifetime value, as we're seeing from the customers who are coming on our offerings, and again, with 44% growth rate this last quarter, building on very strong growth all year long, we're quite optimistic for where our customers and where the puck is going.
RBC analysts, in noting, were saying that the guidance is conservative, and I do wonder, why the conservative guidance?
Well, I think everybody looks and says, boy, VMware, when they say something, we are confident in our guidance. We've been a better predictor of the future, where the markets are going. And overall, I think against that, they're saying, boy, in that high single digits range, they were expecting a little bit higher. But as we look at it, I think everybody is maybe a little bit too euphoric as well on the economic outlooks. And we still believe we have a long way to go until there's a broadly deployed vaccine. So all of that taken together, we're comfortable with the guidance that we've given, and we have a great track record of being able to deliver against what we say.
We talk a lot about Amazon Web Services as well on this program. I am curious about how you think about relationships with some of these more hyper cloud providers.
Well, VMware